markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are dropping with bond yields at multi-year highs. 10-year right now, 3.44%. The 2-year, 3.41%. Stocks are trading mixed. S&P on track, though, for its fifth straight day of declines. S&P down 17 right now, drop there of 0.5%. The Dow lower by 191, down 0.6%. NASDAQ is up 15, higher by 0.1%. Has been a choppy session. We've got the NASDAQ 100 index up 0.2, Russell 2000 down by 0.6. Spot gold down $8 the ounce to $18.10, lower by 0.5%. West Texas Intermediate crude oil down 1.2%, $119.48 a barrel on WTI. Bottom line here, stocks lower on ongoing concerns that the Fed's aggressive policy stance to combat stubbornly high inflation will throw the U.S. economy into a recession. So again, recapping, we've got the 10-year yield 3.44%. FedEx shares surging. It is boosting its dividend, and it has announced board changes. Quarterly dividends going to jump 53% to $1.15 a share. FedEx moving higher now by 13.8%. S&P down 15, down 0.4. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Yep, number one gainer in the S&P 500 happens to be one of my gainers for the simulcast.
At least some stocks are doing well right now.
Yeah, much better than we saw yesterday.
No, it's been a tough haul for FedEx of late.
Yeah, that's true. That's a really good point, right? Perspective. Speaking of perspective, we'll get a perspective on the economy and certainly an update on monetary policy, because tomorrow this time we will have had the fourth FOMC decision of the year. This June meeting, some have likened it that it could be Fed Chief Jay Powell's Volcker moment. So let's get more on that.
Francis Donald is an economist and strategist for Manulife Investment Management. Francis joins us on the phone from Montreal this afternoon. Francis, how are you?
I mean, I'm busy.
Yeah, I bet.
Forecasts and taking in a lot going to. How are you guys?
Well, thank you for taking the time to join us. Well, yeah, and it's only Tuesday, but I'm also really excited for this Fed meeting. I think it's going to be one to watch. So here's my first question to you, Francis. 50, 75, or 100?
You know, I'm not going to fight it. The Fed has somehow, I've never seen this in my career, engineered a monetary policy shock during a blackout via news channels. Sometimes you just have to go with the flow in these things. 75 basis points looks like it's priced in, but that's not what I'm watching for tomorrow. What I want to see is one of two things. Either any information about just how high we're going to go this year and whether we're simply bringing and front-loading all those hikes in. And then also any sort of notion from Fed Chair Powell about whether he's concerned about recession risk. We've seen this from some other central bankers. What does the unemployment rate look on those summary of economic projections? Because it is possible we get 75 basis points, but there's a nod to downside risks, which we haven't seen yet for a while. And I think those are going to be more relevant for a lot of this market than the 25 basis point variation we could see.
All right. So, Francis, I so love talking with you. What I wanted to say is on the Bloomberg terminal on this Flag Day is also a story that traders are betting the Fed will cut rates in 2023 after steep hikes. I do feel, right, that it's not too soon to be talking about the Fed cutting rates.
No, of course not. I mean, the average time between the last hike and the first cut historically has been 8 months. We're in a compressed cycle. So that's what my team did today. We thought, okay, well, we had a more steady rate hike cycle that had a curve steepener in it. We're reassessing that and thinking, you know what, maybe this is a Fed that is more comfortable front-loading a significant amount of hikes into 2022. But I'm only going to add that into my forecast if it comes with cuts in 2023 and 2024. And I got to tell you, I've been on the road with some long-term investor clients over the past couple of weeks, and you'd be surprised how many of them are asking me about what the next easing cycle looks like. And that's the story here for me, is that we are now, almost every model that you look at is going to tell you growth is real darn low in 2023, typical recession or not. We got to start talking about what the implications are for the next 3 years, and the bond market is thinking about that now.
I wonder if your opening act was Jim Bullard as you were on the road, because Jim Bullard is at this point got to be saying, I got this right. I've been talking about this for a long time. Interesting. So can the markets deal with, we've had a lot of whiplash already, you know, pandemic, everything falls off a cliff, lots of stimulus, everything bounces back in a big way. You know, we're seeing another drop off a cliff, high rates. I mean, is this just what we need to get through until we get to some sort of normalcy again? Will things start to then settle down? Because the supply chain and inflation, that's stuff the Fed can't fix. They can certainly reduce demand, but they can't fix that stuff overnight.
The issue is that, you know, at the beginning of the year, I certainly felt like the Fed's tug of war was going to be between inflation and jobs. And we're running all the charts that we have now on unemployment, and it looks like you're going to see a rise in unemployment, the magnitude of which we're not sure of. So the initial call that I had at the beginning of the year was that the Fed's going to have to focus on the second part of their mandate. And yet what's occurring right now is not a Fed that's concerned about a rise in unemployment. In fact, it looks like they're intentionally engineering one. But avoiding a financial accident is going to become very relevant here. Look at credit. I mean, we have IG ETFs that are at the same levels they were in 2020 when we had massive Fed action. Now, it's more orderly, and that's an important distinction here. But we're looking at I suspect that the tug of war the Fed feels right now is not inflation versus employment, but actually inflation versus making sure there's sufficient liquidity and no financial accident ahead.
What would that financial accident look like?
Oh, at this point, you know, it's never what hits you between your eyes, it's what hits you in the back of your head. But we do need to watch some liquidity in the bond market. We do need to watch for, you know, disorderly type of moves that happen across asset classes. These are all things that we need to be monitoring. And some of the tools that the Fed has at its disposal are things that we've been discussing in the last few days, that we may see some sort of need to protect certain areas of the market ahead. And this is really the Fed's challenge, is how do they tighten financial conditions in an orderly fashion. I don't have particularly high hopes.
Does it bother you that both the bond and stock market are trading in cahoots, if you will, and just got about 30 seconds?
The correlations are positive is, of course, very challenging in the asset allocation space. So you have to extend your investment horizon. But I do believe that the equity market has priced in a good amount of the growth slowdown we're heading into. What hasn't is the bond market. And every time the Fed is hiked into a more difficult economic environment, we've seen rates ultimately decline. So I do expect the stock-bond correlation to turn negative again sometime in the next few months, maybe not tomorrow.
Don't tell the rest of my guests, but you really were my favorite interview already for the day, because I think so important, so much you had to say.
I hope nobody else is listening.
Sorry, everybody. Frances Donald, she's economist, strategist at Manulife Investment Management, on the phone from Montreal.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. Carol Massar, Tim Stenovic on this Flag Day in our Interactive Brokers studio. And coming up next, we are going to talk about the apology owed to Jim Bullard.
Yeah, president of the St. Louis Federal Reserve Bank. He's been warning for months that the bank risked losing its credibility. The Federal Reserve, that is, the central bank. Jonathan Levin's got a great Bloomberg opinion piece about this. First up, though, let's get back to Charlie Pellet because we're less than 90 minutes away from the close. Hey, Charlie.
Indeed. Well, hello there, Tim. Fast-moving markets today. Choppy session for the S&P, down 19 right now, down 0.5%. The Dow down 213, down 0.7. We've got NASDAQ up 16, higher by about 0.1%. To be clear, we've got the S&P close to session lows. That would be 22 points. Right now, we've got the S&P down by 20 points. I want to bring you a headline from the Bloomberg Professional Service. Mitch McConnell is signaling that he will support the gun bill. We'll have further details coming up right here on Bloomberg Business Week. 10-year yield, 3.44%. Spot gold is down $9 the ounce to $18.10, drop there of 0.5%. And West Texas Intermediate crude down 1.8%, $118.75 for a barrel of WTI. Federal Reserve policymakers are meeting, and there is lots of speculation about tomorrow's Fed decision. Will it be 75 basis points or perhaps more? Frances Donald is an economist and strategist at Manulife Investment Management. She was our guest moments ago right here on Bloomberg Business Week.
You know, I'm not going to fight it. The Fed has somehow, I've never seen this in my career, engineered a monetary policy shock during a blackout via news channels. Sometimes you just have to go with the flow, and these things, 75 basis points looks like it's priced in.
And, of course, she will be listening to the news conference. And if you're going to be going with the flow, keep it locked into Bloomberg Radio. Yes, we got the decision, 2 o'clock Wall Street time, complete coverage of the news conference. Our Mike McKee in Washington will have that for you beginning at 2:30 p.m. Wall Street time. FedEx boosting its dividend and announcing board changes in coordination with activist investor D.E. Shaw and Company. FedEx shares, they're delivering big gains today, up by 14.2%. Spirit Airlines holding talks with would-be suitor JetBlue over its revised $3.4 billion all-cash takeover bid and will announce a recommendation from its board ahead of a June 30th shareholder meeting. Today, we have got shares of JetBlue lower by 0.8%. Spirit Airlines, its ticker SAVE, up by 3.4%. And Frontier, interesting ticker there, ULCC, ultra-low-cost carrier, its shares down by, actually, they're now trading by unchanged. So again, recapping, S&P down 16, drop there of 0.4. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Man, I can't believe you featured some of our interview from Frances Donald, Charlie. That's impressive. All right, never easy to say sorry, right? And along those lines, Bloomberg Opinion Markets columnist Jonathan Levin puts out that question, like, where does St. Louis Fed President Bullard go for his apology?
Yeah, he wrote that he was the lone member of the Fed's last plot of policy projections to pencil in a Fed funds rate above 3% by the end of the year. And investors, pundits, they brushed him off as the, quote, biggest talk on the committee. Jonathan joins us this afternoon from our Miami bureau. Jonathan, good to have you with us. So where does the Fed's Jim Bullard go for his apology?
I think he could start maybe with Fed Chair Jerome Powell, right? I mean, the way that the market has essentially read Bullard for the past several months is like he would go out and he would give these very compelling presentations, and everybody would just say, well, you know, it's Bullard. He is an outlier. We all see him as a hawk. We don't think he's really indicative of where the policy rate is going. And here we are, June 14th, and the market has converged completely with what one guy was saying was a likely policy path, and that guy's name is Jim Bullard.
So, you know, I guess it always begs the question, Jonathan, like, so what are the conversations within the Fed? Like, who does Jay Powell listen to, and how does debate go about? Who has maybe more leverage or power when it comes to kind of figuring out what ultimately FOMC policy will be?
Yeah, that's a great question. I mean, I think the bigger issue is that all of these folks sort of made their name in a completely different environment, right? I mean, you look at it, and the conversation in this business for the last 14 years now has been, how do we generate some inflation, right? And now, all of a sudden, the job description is completely different, and we're finding out if these folks are actually up for the job.
Well, we know that Fed Chair Jay Powell really looks up to tall Paul Volcker. He has talked about that in public. I've heard him say that he's a personal hero of his in interviews that I've listened to with the Fed chair. He's, of course, read the book about Paul Volcker. So it seems like he knows what it takes to bring the United States out of a high inflationary environment, Jonathan.
It does, and he kind of talks the talk. And yet, if you go back to the summary of economic projections from March, virtually everybody on the Federal Open Market Committee thought that interest rates ending the year around 2% was going to be enough to rein in the worst inflation in 40 years. Everybody, I should say, except for Jim Bullard, right? So you say, well, you may be going before the microphone and saying, I'm willing to pull a Volcker, I'm willing to do what it takes, but I mean, did you ever really think that 2% was what it took?
So is 75 basis points tomorrow, do you consider that pulling a Volcker?
I don't. I mean, I think
you don't?
At this point,
You'd have to go higher?
Well, the reason being that expectations have been completely reset. I think at this point, if they don't do 75 basis points, the market potentially rallies, and a lot of the tightening of financial conditions that is now baked in comes out of the system, and you got to do something else to fight this inflation. So it's just a tricky balancing act that these folks have.
What I wonder too, though, is you have a line in your story about Bullard believes that monetary policy works in part through forward guidance and market prices, as bond and swap markets are already adapting to this new reality. So there's talk about the Fed kind of maybe managing things in this blackout period with a series of stories, Wall Street Journal, Reuters, Bloomberg, talking about a 75 basis point move come tomorrow. So might he be part of those that are pushing for this conversation to get out ahead of the meeting tomorrow?
I mean, look, no, I don't think so. But the Fed definitely operates through expectations. That's how they believe it works right now. That's how Powell thinks it works. That's how Bullard thinks it works. And so they're looking at it right now, and the market is pricing in something like a 4% peak in the Fed funds rate, and they're looking at it and saying, okay, we're actually not that far behind the curve right now, but we still need to follow through. It's essential for our credibility that we actually follow through.
All right, so good to check in with you. Great column. Jonathan Levin, markets columnist at Bloomberg Opinion, on the phone from our Miami bureau.
Let's get a check on the latest world and national news with Denise Pellegrini in the 1130 newsroom here in New York. Hey, Denise.
Hey there, Tim. Thank you. As we've been talking about Senate negotiators working on bipartisan gun control legislation, well, they're talking about a possible vote next week, and there could be even more momentum than we thought, because now Mitch McConnell now saying he will back the bill if it reflects the framework the group has been working on. President Biden will visit Saudi Arabia next month, and he'll meet with Crown Prince Mohammed bin Salman. The president's been under pressure to mend ties because gas prices are at record highs. But Bloomberg's Anne-Marie Hordern reports energy will be just one part of this agenda.
Saudi Arabia and the UAE, yes, are the two countries that have spare capacity, but they don't have spare capacity to solve $5 a gallon gasoline. That's also only one part of the problem.
And Hordern also saying Biden has linked Crown Prince Salman to the murder of Washington Post columnist Jamal Khashoggi. The White House says human rights may be on the agenda for that meeting. The House panel investigating the January 6 attack on the Capitol has postponed tomorrow's hearing. Don't tune politics out during anxious times. That's a message from former First Lady Michelle Obama, appearing for the first time before large audiences since the start of the pandemic.
Sometimes it's just easier to look away, to type in a hashtag, feel like we've done something, and go about our business. But just because it's easier doesn't mean it's right.
And Michelle Obama there addressing the When We All Vote organization she helped create. And job cuts in the New York real estate business. New York-based broker Compass cutting jobs. Redfin also cutting jobs. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Denise Pellegrini, and this is Bloomberg.
Thank you so much, Denise Pellegrini, Carol Masser, Tim Stanovic here in our Bloomberg Interactive Broker studio at Bloomberg headquarters in New York City. This is our third most read story in the past 60 minutes.
Yeah, really good one by Lou Wang and Melissa Karsh. The smart money dumps stocks at the fastest pace on record as a vicious sell-off sent the S&P 500 into a bear market.
This is interesting. So hedge funds, tracked by Goldman Sachs, offloaded U.S. equities for a seventh straight day yesterday, Monday, with the dollar amount of selling of the last two sessions exploding to levels not seen since the firm's prime broker began tracking the data back in April of 2008, which, if you remember, well, let's see, March of 2009 was the market bottom after the financial crisis.
Yeah, the exodus came as the equity rout worsened amid concerns that the Federal Reserve will need to hasten its inflation-fighting campaign at the risk of causing an economic recession. We've spent the first half of the show talking all about that, Carol. As stocks careened and Treasury yields spiked, the fast money rushed to double down on bearish wagers.
Yeah, and it all, in terms of equity selling overall, we saw it picking up pace after the hotter than expected reading in consumer prices dashed any hopes that inflation has peaked. I mean, this has been the problem, right? The narrative has been like, inflation will peak, inflation will peak, inflation will peak. Inflation hasn't peaked.
What about transitory? That was part of the narrative, too.
Yeah, well, we gave up that a long time ago.
We did.
That was thrown out. But, you know, we talked so much yesterday about market capitulation and what we're looking for, and we saw it kind of at the beginning of trading yesterday when all 504 names in the S&P 500 started lower. We didn't close that way, but you really, you know, full market capitulation is just everybody out of everything.
Yeah, the equity sell-off picked up pace.
Certainly.
This was after Friday's, of course, hotter than expected reading of consumer prices. This dashed any hopes that inflation has peaked. The Fed is scheduled to announce its policy decision tomorrow. And Carol, traders, they're pretty much betting on a 75 basis point rate hike.
This is where I want to, like, you know, hey, Warren, what are you doing? Are you buying like crazy?
Oh, that would be Warren Buffett?
Yeah, well, some of us call him just W.
Well, we should also look at the way that earnings expectations have adjusted too. Like PE ratio, for example, on the S&P 500, it's not as low as I thought.
Yeah, exactly. And so these are the things where people are trying to figure out, I mean, have we hit a low? And many would say we're not quite there yet. All right, we're going to talk more about the markets and other things on Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. S&P at lows of the day, down 22 points, down 0.6% after several twists and turns. S&P on track for its fifth straight day of declines. That would be the longest losing streak since January. Again, the S&P down 22 now, lower by 0.6%. Dow Industrials down 230, a drop there of 0.8%. NASDAQ holding on to a 5-point gain, up by about 0.1%. 10-year down 27 seconds. 10-year yield 3.46%. The 2-year 3.41%. Spot gold 18.08 the ounce, down 0.6%. Bitcoin down 3.9% right now, 22,301 on Bitcoin. Crude, West Texas Intermediate down 1.8%, 118.77 a barrel. Well, how's this going to play out in Peoria? Goodbye, Illinois. Hello, Texas. Caterpillar, the producer of those iconic yellow construction and mining equipment, is moving its headquarters to the Dallas-Fort Worth area, effectively ending its century-long history calling the state of Illinois its home. Caterpillar, by the way, also raising its dividend to $1.20 a share from $1.11 a share. CAT is down now by 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, appreciate that update. Well, she has the key to surviving a bear market, so just stop what you're doing. We've got the answers. This story from our Bloomberg Business Week team found online at Bloomberg.com/businessweek and on the Bloomberg.
We're talking about Suzanne Woolley, personal finance reporter for Bloomberg News. She's with us right now in the Bloomberg Interactive Brokers studio. Follow her on Twitter at WealthWatch. All right, Suzanne, the key. Deep breaths, right?
It's a yoga class that we should all do.
Yes, it's financial yoga.
But it's also about assessing your risk.
It is. I mean, now is a good time to just, like you said, take a deep breath, look at your portfolio.
No, don't look at your portfolio.
And I keep joking that we're like,
I thought that's what
not
we're not
doing
supposed to do.
Well, it's true. Like, inertia is sometimes really helpful in investing because it stops you from doing anything too crazy.
Okay, so we're supposed to look at it. We're supposed to open it up.
Look at it after market hours. How's
Okay,
that?
look at it after market hours, wipe away the tears,
Yes.
and then what?
Have a few quiet sobs.
Plan on working until you're 85.
And then, just take a hard look and think, see where you are. Do you have, it's so easy to have gotten overexposed to tech stocks, obviously, because that's what's driven the market. It's been a momentum-driven market in, like 5 big tech stocks. So you want to sort of think about whether that's how you want your portfolio to be.
I'm raising
Carol's
my hand.
raising her hand.
So here's the deal. Like we all said, index fund, right? Spread your risk. We all piled in for years because we thought this is where everything was going. As it turned out, there was a lot of, kind of overweight, right, in terms of certain members. But that was supposed to protect us to the downside.
True.
And it didn't happen.
It didn't happen in the short term. And the short term in the market is very emotional and psychological. In the long term, I think that logic of diversification works. But right now, even after this big drop, the big 5, the Apple, Microsoft, Amazon, Google, they still make up about 20%, I think over 20% of the S&P because it's market cap weighted. Right. So your 500 stocks were really more like 5 stocks, or 10 stocks, and you didn't have that diversification.
Which we at Bloomberg would tell people over and over and over again, and yet we all still kept going there.
Yes.
I mean, all of us.
Well, it's true because it's sort of, there's the FOMO, fear of missing out, and the fact is that we had been in this. I'm just going to ignore the bear market of 2020 because that doesn't really count. It was such a quick one. We have been in such a long bull market.
Right.
A lot of people only know a bull market. So it's very easy to think that this is just going to continue. This is how it is. Painful downdrafts don't really happen, or they're not going to happen to me.
Should we beat ourselves up?
No.
Oh, okay. As somebody who, is very good at doing that.
I don't think you should. I mean, I think if you have a good long-term plan, you have a smart, portfolio that it fits your goals and your life and your age and all that, you should not feel bad. These downdrafts, bear markets happen. And we live through them. Right now, this is really ugly because the tech stocks were so high and they've fallen so far. But the main thing to do is, this is so trite, but not to panic. and not to make any rash moves.
One of the things we just talked about with Francis Donald of Manulife is this correlation and this trade that's going hand in hand between bonds and stocks, right? Both going down, which is not normal. So that whole idea of being diversified, equity, fixed income to kind of protect you on the downside, it ain't working.
Yeah, it's not working right now, but, over the long term, it may work. I mean, Rob Arnott of Research Affiliates that I spoke with for this story, he made a really good point, which is that in the beginning of bear markets, like, everything seems to go to hell in a handbasket, and the diversifiers don't work. But as you get further into a bear market, then the diversifiers really start to pay off. And I think right now we are seeing rates rise, so yields on bonds are going to inch up a bit, and that will, that is an argument that they may play a much better role as a diversifier than they certainly have this year.
So we've taken the deep breaths. We've looked at the portfolio.
Done 5 downward dogs.
We've reassessed our risk. We haven't made any rash decisions. What else do we need to do?
If you sold and are looking for, if you have money in cash, you may want to look at high-yield savings accounts because as interest rates
I keep getting
rise,
emails.
Exactly.
Our interest rate has been raised on your cash account.
It's lovely, isn't it? I mean, it's still, Goldman's...
It still looks low.
It is.
It's very low.
We have been so spoiled.
Goldman's Marcus Bank, I think they just bumped it recently up to like 0.85.
It's like, come on.
I know. It's hard to get too excited over like less than 1%. But I sort of feel like if you have money in like a sweep account in your brokerage account, then you're getting nothing. So I feel like we should at least, if you have money in cash, try to, get something on that money.
I mean, is it smart to kind of, if you have stuff in cash, hold it or maybe add to it? Is it at this point not a smart idea to move anything to cash because of the selling that we've seen certainly so much in equity? I mean, most think we're going to go down even more at this point. And, is there a role for crypto in all of this?
Oh, my gosh.
Carol.
Oh, wow.
The crypto
question.
We can't even, I just feel so weak.
The crypto question. I mean, if you are nearing retirement, then you need to really think about how much cash you need on hand.
What's nearing retirement? 5 years, 10 years?
I'm saying 5 years.
Okay.
Because you can't afford, the worst thing is to have to sell into a down market, obviously, right when you're around retirement age, because you don't have that many, sadly, maybe you don't have that many years sort of in the job market left for you.
Yeah.
So if you take a big hit, you can't really earn it back like a young person. A young person takes a big hit, they have tons of years of earnings potential ahead of them. But if you're heading into retirement and you need to, if you have to sell into a down market, you can permanently hobble your nest egg. So
I will say, in your story, you talk one time a fixed income investment that offers a particularly strong hedge against inflation is a Series 1 savings bond from the U.S. Treasury.
My friends will not stop talking about these. Seriously.
It sounds plain vanilla, but right?
Yes.
They think they're the smartest people in the world because they discovered these.
I know.
I'm like, you did not discover this.
The iPhone.
I can only imagine that conversation.
But I mean, the sad thing is you can only invest $10,000 in them per calendar year. But they're paying, what are they paying? Like, I think it's like 9.6%.
Yeah, something close to 10%.
That's amazing. You can't get that anywhere right now. So that is really a great...
And you have to hold them, otherwise you have to hold them.
You have to hold them for a year, and then if you sell before 5 years, you give up 3 months of interest. But they're a semi-cash-like move, and you can't get that kind of yield anywhere else.
Go ahead, Carol.
Quickly, REITs, too, just about 30 seconds. Also an option?
REITs?
It's in your story.
Possibly, but REITs, they have traditionally been diversifiers, but they're not doing very well lately. They're doing they're joining bonds in sort of the parade down. So in the short term, they're not looking so great.
Dogecoin, cash under mattress. Cash under mattress, that was the other option.
Digging a hole and putting some gold bars in the ground in your backyard.
All I will say, 10 years ago, the market was a lot lower. Right?
Yes.
20 years
This
ago,
is really
5 years.
true.
So just remember, what goes down goes up, what goes up goes down.
Look back 5 years and you're still way ahead of where you...
We're not telling you what to do, we're just a little perspective. Suzanne Woolley, thank you.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close, just 60 minutes left in your trading session. Caroline Hyde, Taylor Riggs, Janali Basak in for Romain Bostic. We miss. Meanwhile, joined by our colleagues Carol Massa, Tim Stenovic. We come together with our audiences, TV, radio, YouTube, to discuss, once again, souring sentiment into this close and volumes only higher in the S&P, Carol.
Yeah, no souring sentiment, though, with, a sector I like to talk about, the Chinese names that trade here in the United States. They are among our top names in the NASDAQ 100 today. But again, the NASDAQ Golden Dragon China Index up more than 6%. No real news, except the CSI did show a rebound overnight where there's some stories about President Xi and President Biden maybe talking. So there's just some maybe optimism about the sector going forward, Tim.
Not so much optimism when it comes to what's going on with real estate here in the United States. I'm watching home builders today. The S&P 500 home building index is down 0.5 percentage point, but I'm watching them because we've gotten so much news about the real estate market here in the U.S. today. Home builders falling after Compass and Redfin both said that they're cutting jobs, given a slowdown in the real estate market. Compass is going to lay off about 10% of its workforce. Redfin is cutting about 6%. The company's saying that in a regulatory filing today, though. Bloomberg did report the Compass news earlier.
Already starting to see the effects of companies foreseeing a slower economy, a cooling economy, and indeed that's what the market braces for as they await the Federal Reserve as soon as tomorrow with that all-important rate hike. S&P 500 off by 0.8%, we're down 29 points. The Dow off by 0.9%, so actually almost the laggard on the day after yesterday being your relative outperformer, but all were underwater. The NASDAQ had been in the green, Shonali so rightly points out, now turning into the red, off by 0.2% as well. And the Russell 2000 is your laggard. You're off by almost 1% in your small caps, down 16 points, Shonali.
Yeah, absolutely. Let's get into some of the sectors here in the S&P 500. We have utilities down more than 3.4%. We only have one sector in the green, guys, and that's infotech up at 0.25%, so not by much. But you are seeing consumer staples and healthcare also leading the sector lower aside from utilities.
I'm also taking a look at some of the big movers. I do pull core just for Romain, of course, desperate for a pool. And, well, Jeffrey's coming out and saying waning demand. Pool core falls 6% on the day.
So it's finally happening. All this backlog,
so that means he won't have to wait
issue.
a couple years for a pool anymore.
I know.
If demand is coming down,
Maybe
now's
you
your
only
chance.
need to wait until 2023 rather than 2024, do you think?
Romain's on the wait list. I think
All
he's
right.
thrilled. I'll keep moving us along here. Align is certainly another company I'm following, because I mentioned this yesterday during the huge market rout. The third worst performer for the year, off 63%, and you fall an additional 3% today. Sort of a symbolic of some of these big high-flying sort of tech stocks, if you will. Then I wanted to point out Caesars and American Airlines. In the last 5 days, these two companies are down 22 and 24%, as you're really thinking about sort of this rotation out of some of the big travel stocks as well.
Meanwhile, we all have our eyes on what the bond market is doing, Taylor's bond market, and what it is pricing in terms of the FOMC meeting tomorrow. Could they go as fast as 75 basis points? This is a beautiful chart for our radio audience, really showing that at the moment the July hike is also pricing. So we've got 75 basis points priced in for June, 73 for July, and then we're going down to about a 50 basis point for September, but then again above 75 basis points for December. This market is expecting a Federal Reserve to go hard, Carol.
Yeah, absolutely, right? They are expecting an aggressive Fed in the meeting tomorrow. I mean, less than 24 hours from time, we will be all over that Fed decision. And, some are expecting Jay Powell to kind of have his Paul Volcker moment in that he will be aggressive, just like Volcker was back in the 1970s. Seema Shah has been talking to Bloomberg. She's the chief global strategist over at Principal Global Investors. She's talking to Bloomberg, addressing the market volatility we're seeing today. She says the volatility today is a testament to the uncertainty going into the FOMC meeting, as well as concerns about the impact such an aggressive ramp of tightening could have for the economy. The 75 basis point possibility was a far-flung risk this time last week, so market participants are having to quickly revisit Fed economy and market forecasts. I mean, we're all scrambling. What's crazy is, did you guys see this story on the Bloomberg that traders are betting the Fed will cut rates in 2023 after steep hikes? So get ready for some continuation of wild swings.
Well, we're talking to Frances Donald, economist and strategist at Manulife Investment Management, and she made the point that the average time between the last rate hike and the first rate cut is traditionally 8 months. So it's not necessarily too soon for investors to be thinking about that.
You know, it's interesting that you mentioned this too, because I've been reading all this data from the Journal of Financial Data Science, thanks to Barry Ritholtz. And the problem for a lot of investors is that they don't know when to get back into the market. So will they survive until that point where they can get back in, or will they not make it through this time around?
We will learn the age-old adage, right? Time in the market versus timing the market, at least for some of those long-term sort of institutional investors who have the time period of going long, Caroline. But it has been sort of a quick move higher. When you think about some of the flattening of the yield curves that we've talked about, huge now highs of the day for yields, a 5-year and a 10-year, that's up an additional 12 basis points. Well, I think I was throwing out a statistic earlier, one of the biggest one-day and even weekly moves that we've had since 2008 on the front end, and I'm just astounded at the rate of change. When the facts change, you have to change with it.
Meanwhile, I loved Katie Greifeld's piece out today, just showing that actually the wild ride, the white knuckle ride that you're getting in treasuries is far surpassing some of the turmoil that you're seeing in terms of the standard deviation move in crypto. So your beloved treasury market at the moment, Taylor, giving whipsawing to the market far more than crypto is for once. So I thought that was a remarkable story.
Yeah, it was a great story. And meantime, it's really tough for investors, right? Because you've got stocks going down, you have bonds going down. So this traditional portfolio of diversification of bonds and stocks is once again not working, making it really, really tricky, Tim, for investors.
Okay, well, so here's what surprises the markets at this point. It really seems like investors are expecting 75 basis points tomorrow, but what if the Fed comes out and says 50, or perhaps even gets more aggressive?
JP Morgan thinking that.
Yeah, I would argue most of the notes I read this morning, Wells Fargo, NatWest, Piper Sandler, all saying that why 75 isn't a slam dunk. The fact that it's on the table and maybe was communicated by the Fed's communications office yesterday to the Wall Street Journal shows that it is being seriously considered, and that that actually could be more of a base case than we think.
That's pretty remarkable, and it's a point that Francis Donald made to us too. The fact that during a dark period, this news came out.
A classic Bernanke, always to the Wall Street Journal.
Right.
It's incredible.
You still have the VIX over 30 here, and you've got to wonder whether no news would bring some volatility down. Once again, we have, of course, seen a volatile VIX, and the question is if it remains this high, is the market still going to just be stifled for a while here?
But interesting, the VIX down today. Like, it just feels like we have volatility, and yet, the VIX is an indicator. I just kind of scratched my head a little bit over it. All right, we're going to come back in less than an hour's time, continue the market conversation, our simulcast, our cross-platform coverage on radio, TV, and YouTube. We will count you down to the close on this FOMC Eve on this Tuesday.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I love that point from Francis Donald about 8 months between last rate hike and when the Fed starts cutting.
There's got to be,
it's pretty quick.
It's really quick. And I think Suzanne Woolley makes such a good point about the people's mentality when it comes to bear markets and how quickly this stuff shifts, given the way that people are thinking about their own portfolios, given the way they're thinking about volatility. It's the type of market environment, Carol, that people who aren't in the markets day to day start to talk about. So I took my son to the doctor this morning, to the pediatrician.
Did the pediatrician ask you?
Yeah, he's like, so you must be pretty busy at work right now, right?
like there's something unusual?
Yeah, and exactly. And well, he's like, given all the terrible news, and he was talking about the business news. He was talking about inflation. He was talking about what the Fed is going to do. It's
was
pretty
he
remarkable.
Feeling it? Did he say, did he give
I didn't
any
dig in. I don't want to ask too many questions.
Yeah. No.
Doctors, they keep things private.
They do keep it private. But it is. It's like, do you remember during precursor to the housing meltdown and the financial crisis, I said, it must have been a peak, like here I am at a yoga retreat in Mexico, and everybody's talking about the real estate that they're buying as an investment.
Yeah,
like it was crazy, frenetic, and there's a point where you're like, wait, this makes, when the cab driver's buying real estate?
I told you this a year ago when the Uber driver was giving me tips on which, cryptos to buy.
Yeah, so listen, markets work their way out. Sometimes it's more painful than others. I do think what was interesting too, Francis Donald talking about what the Fed is dealing with, not inflation versus employment, but inflation versus no financial accident ahead. And that's where you worry about liquidity conditions and maybe corporate credit or what have you. We're not quite sure what, to be quite honest.
Well, let's go to world and national news. For that, we turn to Denise Pellegrini in the Bloomberg 1130 newsroom in New York. Hey, Denise.
Yeah, you were talking about crypto. Bitcoin is down another 4% now. It fell, of course, more than 15% yesterday. Getting a lot of questions about that wherever I go. Senate negotiators, meantime, on Capitol Hill working on a bipartisan gun control legislation package, and they're talking about a possible vote next week. And there is momentum with more and more people saying they could potentially support it. President Biden saying some Republicans are possible to deal with, others not so much, and he's blaming them for roadblocks on some of his legislation.
I have no illusions about this Republican Party, the MAGA Party. I've been able to bring some Republicans along on parts of my plan. But the fact is, Republicans in Congress are still in the grip of the ultra-MAGA agenda.
And Biden speaking there to the AFL-CIO convention in Philadelphia. President Biden will be heading to Saudi Arabia next month in a visit with Crown Prince Mohammed bin Salman in the cards. The White House confirming that trip is part of his Middle East visit. He'll also be going to Israel. The president once promised to make Saudi Arabia a pariah. But Bloomberg's Anne-Marie Hardern reports the situation has changed.
The war in Ukraine, Russia's invasion of Ukraine, that has started to shift the tides in a number of capitals around the world about making sure they shore up their allies. And it changed a lot of diplomatic priorities, and that's obvious for this administration.
And Hardern also saying Biden plans to go to the West Bank in addition to Israel and Saudi Arabia. Apple will be streaming Major League Soccer as its sports ambitions grow. And some matches will apparently be free for Apple Plus subscribers. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Denise Pellegrini, and this is Bloomberg.
Thank you so much, Denise Pellegrini, with a World and National News update. Hey, we're going to talk about
crypto.
A lot of and we've got a great story coming up about billions lost to 7 individuals. But in the meantime, you know, there's firms in the crypto segment that continue to lay off workers and kind of readjust their businesses.
Yeah, I want to start with Coinbase because this is the story that broke this morning. Coinbase announcing earlier today it's going to lay off 18% of its workforce in another sign of a worsening crypto downturn that shaved off hundreds of millions in the total cryptocurrency market value. I was online and covering this when it happened this morning.
Yeah.
And I read through the note from Brian Armstrong at Coinbase, and he said that the people who will be affected, they've already had their email systems turned off, so they're getting notifications that they've been laid off to their personal email addresses.
That's pretty harsh.
Yeah.
And that's a lot. This stock is down 79% so far this year. It's probably more, right? Probably from its high or even IPO.
Yeah, the company came out and said that it hired too aggressively. Its workforce ballooned by about 1,200 employees just this year. The company plans to fire roughly that amount, that number, ending the current quarter with about 5,000 employees.
You know, coming up we're going to go to Texas. You talked about this earlier, and I'm going to moderate a panel that involves 2 well-known names in the crypto space. And one of the things I want to ask them, we're going to be talking about the future of money. What is it? How do we think about it? And we're certainly going to deal and delve into the digital world. And like, I just have a series of bad headlines and trying to understand.
Well, that's my question.
Right?
That's my question with a route like
Terra
this.
USD, and then there's other things going on.
So to what extent does that completely scare people away from crypto, seeing the way that fortunes have been wiped out, the way savings have been wiped out in recent weeks, in recent months? What does it do to the industry?
Like, I don't know. And I do wonder.
Do people say, I don't want to touch this stuff?
Right. Or does it shake out some of the fluff, right?
But even if the fluff is shaken out, do people say it's too risky for me because look what just happened? Well, Bitcoin was the, blue chip crypto.
I would still argue, what is it? Like, how do we need to think about it? And is it like a high-flying, early investment that we need to think of? I don't know. I just don't know. Anyway, we're going to talk more in a moment.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lows of the day, the selling is intensifying. This update brought to you by Informatica in the cloud. Your data has the power to do the extraordinary. Manage data across any location in the cloud for accurate and actionable insights. More at Informatica.com. The Dow, the S&P, NASDAQ, all in the red with 43 minutes to go ahead of the close. Let's get right over to the first word breaking news desk for today's afternoon call. And here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are falling and on pace for their longest slide since January. The Dow is down 350 points, S&P off by 40, while the NASDAQ is lower by 60 points. The U.S. 10-year yield is at 3.48%. Small caps are down 10 points, and Bitcoin is trading back below $23,000. All 11 main S&P sectors are trading lower, with utilities and consumer staples as the worst performers. Nasdaq Biotech's dipped 20 points, transports gained 215, semis are little changed, while the VIX is lower by 3.5%. Leaders in the Dow, Boeing, McDonald's, and IBM, while Procter & Gamble, Coke, and Disney are the worst performers. FedEx is on pace for its biggest gain since 1993 after hiking its dividend and shaking up its board. Oracle climbed after quarterly earnings beat expectations. Coinbase announced plans to cut 18% of its workers, and Continental Resources gained after Harold Hamm offered to take it private. Wrapping things up, Boeing gained on a report 787 deliveries may resume in the coming weeks. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey, and to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week, among our most read on the Bloomberg. And yes, this may be a moment to get out your tiniest violin, and yet it's significant. It pertains to a big market story of our time. It has to do with crypto, Tim.
Yeah, Tom Maloney is editor at Bloomberg News. He's with us right now in the Bloomberg Interactive Brokers studios. He writes today all about the crypto billionaire fortunes that have vanished just as quickly as they were made. Tom, good to have you with us. Is that your tiny violin?
Yes.
All right, well, it is still tiny because, all the people on this list are still billionaires right now, but they are less billionaires.
I was so worried.
Yeah. Okay, well, we should name some of these names, okay? CZ, over at Binance. People know him as CZ, Changpeng Zhao. SBF, Sam Bankman-Fried. They all have initials. They're like Madonna, right?
Yeah.
They're all known by these things.
That's right. Don't forget the Winklevi.
I was just going to say, there it is. So take us through the fortunes that have been lost here, because there are different types of cryptos in different types of companies too.
Yeah, well, most of the folks that we track on the Bloomberg Billionaires Index are associated with crypto exchanges. So people like CZ, as you mentioned, founder of Binance, Sam Bankman-Fried, founder of FTX, Brian Armstrong, Coinbase, the Winklevi with Gemini. And those businesses have really gone from last year when there were kind of sky-high valuations and a lot of optimism about the future of that industry to the total opposite now, real pessimism, job cuts at those companies, and that's obviously had a massive impact on the fortunes of these folks. Last year, in November, when crypto prices were at their peak, these guys collectively had a fortune of about 145 billion.
Wow.
They've lost 114 billion of that down now. So
That's
they're around about 30 billion.
So how do we think about this? Like, is this akin to a lot of the internet billionaires or millionaires, back in the day of 1999 and 2000, like similar haircuts of just, companies that people who seem to be wealthy on paper and then just were not?
Yeah, look, I think there are massive parallels with that era. The crash that we're seeing in crypto, a lot of people are comparing it to the dot-com crash. Obviously, a lot of fortunes ended up still being made from the internet. We might see the same thing with crypto. I think it's too early to say. Look, these guys are still billionaires, they're still massively wealthy, but a massive come down from last year.
Well, we can't forget the Winklevoss twins are touring as part of their band right now. People were tweeting about this earlier this week with all the news about Gemini.
Frances McDonald is the oopening act for them.
Strange.
She's touring too.
I did not know that.
She talked about touring.
That's great. Their band is called Mars Junction, by the way.
That's right, they're at Brooklyn Bowl last weekend. I could have gone down and see them. I didn't find out until I wrote this story.
Next time we'll have to do that. I did see some pictures circulating on Twitter. An interesting name on here, Mike Novogratz, because that's not necessarily an exchange. And this is also a guy who's made and lost fortunes before.
That's right. Novogratz was a hedge fund manager basically at Fortress. He was a macro fund that ended up being wound up back in 2015, I think. He's kind of remade himself as a crypto evangelist. Last year in November, when crypto prices were at the peak, he had a fortune of about $8.5 billion, and now he's at $2.1 billion. He's also been kind of closely linked to one of the crypto scandals, I suppose, that sort of kicked off the crash in crypto prices, which was Terra and its sister coin Luna that collapsed last month. He was a big proponent of that coin, going so far as to get the Luna tattoo infamously on his arm last December, or in January rather.
Tattoos are permanent. Crypto fortunes, not so much.
That's right. Yet to get a Bloomberg tattoo, as much as I love this company.
You still got a few more years.
Yeah, I do have a few more years. Hey, one thing I do wonder is when there's somebody who's so entrenched in an industry, anybody who's saying, I'm out at this point. I know some of them probably can't because they're still involved and there's financial positions at stake. But I do wonder, is there anybody who's just been like, I'm out of this. I've changed my tune a little bit.
Well, none of the folks on this list, for sure. I mean, these are people who, their fortunes are still entrenched in these companies that most of whom, these guys are all founders of crypto-focused companies, so they're not going to be getting out anytime soon. And I think that all of their statements, they've been as committed to crypto as ever.
Michael Saylor keeping the faith.
That's right, Michael Saylor of MicroStrategy. We haven't mentioned him yet.
We've talked to him a fair amount of times. Yeah.
Right. Yeah. So we haven't tracked his fortune, but the stake in MicroStrategy that he holds now, I mean, that the share price of MicroStrategy is down around 85% from its peak, and his company has racked up about $1 billion in paper losses on its Bitcoin investment.
Before we let you go, Tom, I want to talk about El Salvador's president. I went to his Twitter feed yesterday because I was wondering if he'd tweeted, and he hadn't as of yesterday. Because this is a country that made it legal tender just in the last 20 seconds that we have. How should we think about that?
Well, look, I don't think it's great for El Salvador's finances. Obviously, they've been buying Bitcoin, I think, at an average price of $36,000. It's now just above $22,000. So, they've got some serious losses on their hands. I was looking at his Twitter feed as well. He still has the laser eyes on his profile photo, so I guess he's as committed as ever.
I do wonder if, we look back, 20 years from now, and we say, okay, Bitcoin, had some problems, but it becomes something much bigger and is really a part of our
We'll be looking back
system.
From the metaverse.
Yeah, exactly, we will be. Tom Maloney, thank you so much. Editor of Bloomberg News here in our Interactive Broker studio. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week. And coming up, there's a story I've really wanted to get into is lithium, because it's a really important component when it comes to electric vehicles and their batteries.
Can I sneak a couple questions in there about Bitcoin, too?
Yeah.
Given who we're talking to?
Mike McGlone's coming up, isn't he?
Okay, thanks. Senior commodity strategist. He knows all things commodities, including crypto. First, though, Charlie Pellet, we are less than a half hour to go for today's equity market close.
Indeed, and I've got to check into what's going on. Sudden bounce off the bottom here, substantial bounce off the bottom. Yes, red on the screen, right to the numbers. We'll get to what's happening in a moment here with the S&P down 21 right now, drop there of 0.5%. To be clear, we're off session lows, but still losses. Could be 5 in a row for the S&P. Got to keep it locked into Bloomberg Radio to see how things shake out right at the close. NASDAQ, as I speak, just turning positive, up now by 1 point. Fast-moving markets here. We've got the Dow down 169, drop there of 0.6%. 10-year yield 3.48%. Look at that on the 10-year. We've got the 2-year right now 3.43%. Spot gold down 0.5%, 18.09 the ounce. West Texas Intermediate crude down 2.2%, 118.23 a barrel. And Bitcoin right now, we'll have more with Mike coming up in just a moment here, down by 4.3%. Bitcoin 22,230 right now on Bitcoin. Pershing Square founder Bill Ackman says the Fed could help restore market confidence if it takes what he calls aggressive action by raising 75 basis points tomorrow and again in July. Now, as for the economic backdrop, Claudia Sahm is Director of Macroeconomic Research at the Jane Family Institute.
Frankly, what we're seeing in the last several days is what could easily turn into a self-fulfilling prophecy of spiraling down expectations, both in financial markets and also potentially among consumers. We need to see things cool off some. Again, on the demand, that's the tool the Fed has. But if we cool off too fast and too much, that's where we end up in a recession.
And again, that 10-year yield, 3.48%, and a setup for commodities. Billionaire oil investor Harold Hamm offering to buy the rest of Continental Resources that he and his family don't already own and take the Oklahoma City-based shale driller private. Right now, Continental Resources up 13.5%. Briefly, cryptocurrency company Coinbase Global cutting about 18% of its jobs. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, so as I said, thank you so much, Charlie. As I said, I've been really dying to talk about lithium. It's a vital component of EV batteries, very much in demand today. There is a story on the Bloomberg you might want to check out. It talks about how the red-hot lithium boom pits Wall Street against the wonks. Apparently, there's some debate over a bearish forecast that was put out by Goldman. So there's a lot of debate about kind of where this is going.
Yeah, for years, Carol, a small group of niche consultants has dominated the conversation in a commodity that some say will become as important as oil in the coming century. Let's get into it with Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. He knows a thing or two, not just about oil, but about lithium and more. He joins us on the phone from our Miami bureau. Mike, what do you think? Is lithium going to become as important as oil in the coming century?
Well, the key point to remember about this is part of rapidly advancing technology, moving away from oil and using to a new commodity to address what we are doing now. We're just going electric. It's decarbonization, electrification. It's not going to become as important as oil, but the key thing about lithium, just give it 10 years, 20 years from now, we'll probably find a better substitute even to lithium. And the key thing to think about here is what I enjoyed about that article is I point out how the different analysts have different views, but that's why it's so important. Commodities, it's that rapidly advancing technology might shift so fast. And I'll end on this. Look, like one key thing that really happened today was what happened with natural gas. It plunged because people realized you need this strong technology to export it. We have so much extra supply in the U.S. because of that technology. We can't get it out enough.
Yeah, I think that is so interesting what you said about kind of these big swings that we can see in things. Lithium market, though, is not something, Mike, that we have often talked about, but we should be.
We should be, but the key thing about lithium is, in from my space, when I hear investors want to get in, oftentimes they'll buy like an ETF, the LIT ETF, because you can't just go buy actual lithium like you can a crude oil ETF, because it doesn't trade active futures. Maybe it will someday. It's a specialty chemical. It's kind of like a rare earth metal. So they'll go to the ETFs, and then that puts the people who need to hedge it a little bit at risk. But I think we will be speaking more about it. Just one key thing about this factor is it's related to cobalt and nickel and copper. And the biggest one of them is copper. And copper's down 5% on the year because it's seen those headwinds of global GDP declining and recession.
So to that end, Mike, what are the commodity markets telling us about economic growth? What are the signs that you're seeing?
I think we saw bell ring today that this is the top. When you see LNG plunge like that and people not understanding why, it just pointed out the problem is supply in the U.S. We can't get it exported enough. When you see the Fed tightening 75 basis points, particularly they're being baited into it because of one bad number, while GDP is plunging, just had the worst consumer confidence in the U.S. ever since 1978. And plunging stock market, to me, what that tells me is a year from now, we're going to be more and more about deflation and commodities have peaked. Look at crude oil, $120 barrels today. That's still about the same price as 2008.
So when you look at the commodity space overall, because I do wonder when we're going to start seeing, and I'm watching just the energy market alone, which has been such a high flyer last year, this year, in terms of the equities within the energy space, and of course the commodities as well. But to see it starting to back off, I do wonder, demand destruction or also just concerns about an economic slowdown, especially when we've got a story in the Bloomberg where, traders are starting to price in interest rate cuts come 2023.
Exactly. It's called the higher price cure, Carol. And in 2008, we went up to 145 and dropped to 40. I fully expect that can happen. That's the key thing that happens. And let's look at crude oil. It has notable for booms and busts. I was in the trading pits in 1990. It went from 20 to 40, then back down to 20, and it took 13 years to get above that high. The difference is now the U.S. is a massive net exporter. Yes, we've had a major discombobulation with the war, but remember, just 2 years ago, it was a negative price. It's these wide swings. Price drives everything. What's going to happen, I think, within a year, we're going to have massive supply. And demand destruction is always showing signs of peaking. We're seeing peaking U.S. unleaded gasoline demand, peaking U.S. diesel demand, and that's not profound. It's fully what you expect when prices jump this fast.
When should we see that? That's the question.
Oh, like I said, I think the bell rang today. If a week from now crude oil is higher, you can say McGlone was wrong, and yes, I have been wrong. But I point out now we see everything starting to trickle lower, and the fact that the Fed's going to raise 75 basis points when they probably really don't need to, maybe in next month, because all it needs for lower prices and everything now, lower inflation, is for the stock market to continue down at a similar velocity. So say by the end of the year it's down 40%, we're going to have deflation as a bigger problem.
If you're watching on YouTube, you see me grinning because we've had this 50-75 debate throughout the day with our guests, Mike, and also just between Carol and me too.
Yeah, I mean, right? Like you do wonder, is the Fed going to overdo it tomorrow?
Well, it's complete bait. If they don't do it, then we're going to have this relief rally, and that's the last thing the Fed wants is risk assets rally. So now they kind of have to, but the problem is this might be the last one. Let's say for the next meeting, if we drop 10%, that'll be it. We'll be done.
Yeah, see, this is like fascinating. Mike McGlone, fun. Senior commodity strategist at Bloomberg Intelligence from our Miami bureau.
Let's get a check on the latest world and national news with Denise Pellegrini in the Bloomberg 1130 newsroom here in New York. Hey, Denise.
Yeah, you're talking about interest rates rising. Well, we've got job cuts in the real estate business as those mortgage rate spikes. Mortgage rates today hitting more than 6.2%, and real estate broker Compass cutting about 10% of its workforce, and Redfin is also cutting jobs. On Capitol Hill, Senate Minority Leader Mitch McConnell says he's inclined to support that gun safety deal that a group of bipartisan senators has been working on.
I think if this framework becomes the actual piece of legislation, it's a step forward on a bipartisan basis.
But McConnell also does say that he will only support it if the final package sticks to that framework. Voters today going to the polls in several states, including Maine, Nevada, South Carolina, and in South Carolina's 1st Congressional District, incumbent Republican Nancy Mace facing a challenge from Katie Arrington, who has the endorsement of former President Donald Trump.
She's not a conservative. That's why I'm running. She turned her back on us in the district. She turned her back on Donald J. Trump.
So Trump is backing Arlington after Mace criticized the former president after the January 6th insurrection. In Suffolk County, police say at least 14 children have been injured when an inflatable slide tipped over at a Long Island park this morning.
Some of them fell on me, and some of them did not.
And some of the 6- and 7-year-old children are being treated at the hospital. A statement from the Wyandanch School District says the slide deflated while the kids were on it. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists in more than 120 countries. I'm Denise Pellegrini, and this is Bloomberg.
God, that is disturbing, huh? Oh. All right, Denise, thank you so much. One of the stories that definitely caught our attention as we track people going in and out of work amid COVID resurgences, if you will.
Out of work, you mean?
Out of work. In and out of work?
Yeah, not in. They're just like not going to, they're just not going.
Well, that's because, you're saying that because of Thomas Buckley and Jeremy Scott Diamond have a story on the Bloomberg today. Wall Street's out of office again amid a COVID wave.
Yeah, recent surge of COVID-19 cases here in the city is plateauing, is showing signs of lingering symptoms. Bankers are not rushing back to the office. This is what is called the Pret Index. Okay, here's how it works. In the downtown cluster that includes Wall Street, Pret-a-Manger's sales of coffee and sandwiches are less than half of what they were before the pandemic began. Earlier this month, they fell to that lowest level since January after the city's health authority recommended wearing masks again to contain the spread of the virus. I know that Pret well, by the way.
Do you?
The one right by the New York Stock Exchange.
Oh, you do?
Yeah, I've spent a lot of money there.
Well, because it's where people go to get breakfast, lunch, right? All that good stuff. No, so this is interesting. It's been a way of tracking who's in the office, who's not, and giving us an idea of how many people are going back to work. And this is something, we certainly feel just anecdotally as we move in and around the city. The city certainly has felt busier.
Okay, here's what I wonder.
What?
Now that we're starting to see layoffs, yes, we are still seeing, people get mad when I say this, but the truth is 2 jobs for every 1 person here in the U.S. right now, according to the latest data.
Yeah.
What happens when that number changes, when unemployment starts to move higher, and companies say, hey, we actually, if you want to work here, you do have to come in 5 days a week? Are you going to see people saying, nah, I want to come in 3? Or are they going to take the job and go in 5 days a week?
They're going to come to the office.
Exactly.
I'm sorry. It's just the way. Like right now, workers are in the driver's seat. I do think, though, companies...
Right now they are.
You and I have talked about this, that companies, though, there is an asset of being able to grab from a greater pool of workers if you can look at the entire world and say, well, why can't I have this person working here? You know what I mean? Like their pool of available workers is larger if they let workers work from home.
Also industry
which
by
is an
industry.
asset. Absolutely. Not everything can be done, certainly working from home. Anyway, this is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We got ourselves a wild finish underway here. 13 minutes to go ahead of the closing bell. I always say you got to keep it locked into Bloomberg Radio to see how things shake out today. No exception. Right now, S&P narrowing its loss to 6 points, still down 0.2%. However, at the worst level of the day, we'd had the S&P down 1.3%. The Dow does remain lower, down 85, have been down as many as 372, down now by 0.3%. We are seeing a late-day recovery. NASDAQ holding on to a gain right now of 42 points, up by about 0.4%. NASDAQ 100 index back in the green, also up by 0.4%. Russell 2000 does remain lower by 0.3%, but right now, little change for the S&P, down by 6 points. 10-year yield 3.48%, the 2-year yield 3.43%, and we have got spot gold down $10 the ounce to $18.08, drop there of just about 0.6%. Also keeping an eye on West Texas Intermediate crude, down 2.1%, 118.33 a barrel on WTI. Bottom line here, stocks do appear right now to be set for another losing day, down for a 5th straight day. That would be the longest losing streak since January. Recapping, S&P now down by 4, down 1/10, 10-year yield 3.48%. And that's Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
For too long, a common-sense agreement to fix America's gun laws has seemed out of reach. A new effort in Congress offers reason for optimism. This week, 10 Senate Democrats and 10 Republicans compromised on a framework for what will likely be the most significant gun control legislation the U.S. has seen in years. Their plan won't please everyone, but there's no question it represents progress. Importantly, it will encourage states to enact red flag laws, which allow courts to temporarily remove firearms from individuals in crisis. It would also ensure that domestic violence records are more widely included in background checks and boost penalties for gun trafficking. The framework is modest, no doubt, and ought to be a starting point for wider change. But after a decade of congressional inaction on gun safety, every step forward, big or small, should be welcomed. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10.5 minutes left in today's trading session. Another volatile day. One day, in less than 24 hours, we'll have that latest Fed decision at that June meeting and get an indication of what the Fed might be doing for the rest of the year. So let's get to it.
Megan Horniman is Chief Investment Officer at Verdance Capital Advisors. Megan joins us this afternoon on the Access line from Hunt Valley, Maryland. All right, Megan, I'm going to ask you the same question I've asked other guests today. What happens tomorrow from Fed Chair Jay Powell and the FOMC? 50, 75, or 100?
It's like a Twitter poll.
Exactly. Yeah, I'd love to see them go 75 and insinuate that we'd have 50 in the coming meetings. But the only thing that holds me back from there is he did make it pretty clear at the last meeting that 75 was not on the table for this meeting. But keep in mind, there's other ways that he can insinuate, more tight policy.
Was that the last meeting, or was that the meeting before that? I'm trying to remember. They're like...
The last meeting, he said that was not that. It was in the press conference that he was asked if it was on the table, and he clearly said no.
But remember, the data changes.
The data does change, but the transparency of the Fed is very important. It's important to markets. So there are ways that they can get around by maybe saying, it's only going to be 50 this time, but they can also maybe accelerate that balance sheet runoff. They could double that in size instead of keeping it where they had.
I want to make sure I understand this. You're saying, Megan, that they'll do 50 because it's important for them to be consistent with their previous messaging. and keep
credibility, right?
Credibility.
And credibility, but I think at the same time they could do other things that they didn't make any mention of. They were very clear that the balance sheet runoff, could accelerate that if necessary. So I think you may see some acceleration in that balance sheet runoff to kind of make up for those people that were looking for 75. But I also think that they can, and maybe by learning their lesson, insinuate that the rate hikes in the next couple meetings could quite possibly be higher than what we have.
Right. To use this meeting, right, because if we want to make sure that the markets respect these Fed meetings and what is said, right? Like they could say, okay, let's do what we said we would do, and then open the door for maybe being more aggressive at the next meeting. Right? And there is a lag. Like we need to understand. I mean, although it does feel like the needle isn't moving aggressively enough when it comes to inflation coming down.
Yeah, and keep in mind that they also are looking at economic data, which is getting soft very fast. So they have to keep that in mind. I mean, consumer confidence at a record low.
That's true.
And these are things that they have to take into consideration. Gas prices where they are, this is going to hurt the consumer.
What else are you seeing in terms of softness right now? Because we're still seeing some hotter than expected prints.
Yeah, the one thing that we'll look closely at is the retail sales that comes out tomorrow. Keep in mind that'll be for May, and May was when we hit another record high in gasoline prices, a very big jump in the month of May. So we'll be looking at that for any softening in the consumer. If you look at things like small business optimism and some of the different components within that we see, that's weakening. The housing market is just looking very, very, very weak. So I think there's a lot of things that they can point to that suggest, hey, we have to be aggressive. We have to be flexible. He's probably kicking himself that he made that comment in the last press conference that he wouldn't go 75. He's got to make it very clear that it's a very fluid situation. We may need to go higher and more aggressive in the coming months, and we may need to be flexible with the balance sheet runoff as well.
No, that's a really good point. Nobody's really talked about, using some of the other tools in the toolkit, right? And we have talked about that, when the Fed starts doing rate moves, but it's also got the balance sheet. That's a double whammy. Like that is, they're both going to impact what's going on in the economy and liquidity in the markets.
Yes, and the one thing that they also need to address to kind of give themselves a little leeway if they need to come in with 75 or 100, they could come in with emergency measures in between meetings.
Remember when the Fed, I keep saying, I was having a conversation, I said, I used to remember you'd wake up in the morning or I was doing an early morning show and all of a sudden, bam, like across the Bloomberg would be the Fed doing an emergency. Like they don't do that, it feels like anymore, unless it's a crisis.
Right, and I think that they can make note that these are things that they may utilize. So we may come in next week and we get another really bad print on something from an inflation standpoint, and they come in and they say, okay, we're going to go another 50. So they need to keep at this point, all of their tools out there so that people aren't necessarily surprised if they use them. I think that they should go more than 50. I think 75 at a minimum for this. But I just don't know that they're going to be able to do that with how they kind of pitched themselves the last time.
So what's an investor to do in this environment?
So it's very frustrating, and I completely understand that, because any hedges that you typically would use in an environment like this, I mean, let's talk about it. We've got elevated inflation pressures. We have a Fed that's doing everything that they can to get that inflation under control, but the Fed can only go so far. Some of these other inflation pressures are due to supply chain reasons, and then maybe too much fiscal stimulus that was put out into the economy. Those are things the Fed can't control. They also can't control, other countries when they go on lockdowns, which then exacerbates the supply chain problems and then creates a weaker global economic situation. These are things they can't control. They can only control what's here. So right now, an investor needs to be patient. Look at some of those areas in the market that have priced in the majority of the pessimism, because we are in a bear market, and what history has told us that these are part of any investment cycle, and if you're patient and you add a little bit in when it goes down a certain amount, and then maybe a little bit if it goes down another 10 or 20%, that these end up being good potential good buying opportunities.
So wait, let me just ask you, because we've only got about 40 seconds left here, Megan. Is it all about, though, capital preservation, where to hide at this point, or is it where to look for some really great opportunities? How do we need to think about it?
Long and short term. So long-term investors, you should be looking at opportunities in the market right now. Short-term investors, be really defensive, because I think that this summer, at least at a minimum, will be a pretty rocky and volatile time for the market.
Which is, it's already been.
Yeah, when does summer end?
And it's only June 14th.
I know.
Can we get to fall pretty quickly? Megan, thank you. Megan Horniman, Chief Investment Officer at the Wealth Advisory and Multifamily Office firm Verdance Capital Advisors, with us on the phone from Hunt Valley, Maryland. I think she made a really good point that the Fed could be more aggressive with the balance sheet, and you do wonder about Jay Powell wanting to be like, this is what I said. I'm not going to muck around with it because that has to do with my messaging and respect and credibility, basically.
I know. Look, only they know.
Only they know. That's true. And we'll know in less than
Tomorrow.
24 hours' time. All right, let's get over to our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we are about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Janali Basak is in for Romain Bostic. We count you down to the closing bell, and here to take us beyond that very bell, it's our global simulcast. Carol Massa, Tim Stanovic, bringing together TV, radio, YouTube audiences for Bloomberg to dissect what has been a pretty volatile day of trade and actually bouncing off our lows as we head towards it, Carol.
Yeah, and I've got a provocative thing to share with you, and I know both Tim and I want to do it. Megan Horniman of Verdance Capital Advisors was just on our air moments ago, and she said, you know what, I don't know that the Fed's going to do 75 basis points. I know the market expects it, but Jay Powell said he would not at the last meeting, and maybe they use the balance sheet more aggressively to really affect the markets more.
But she said it's all about credibility, because Jay Powell said that 75 basis points was pretty much off the table. I pushed back and I said, but the data has changed. But she said that the Fed needs to remain credible.
Yeah.
Yeah, indeed.
What do you think?
He
Don't
said
you
it
think this
wasn't,
is interesting?
Yeah, I'm not sure about the balance sheet. I'm not sure about the balance sheet. The point is also, why not? It all comes down to a question of whether or not it was indeed a leak from the Fed or not. Because if it wasn't a leak from the Fed, then they remain credible. If it was, then why on earth leak it if they could have just signaled it in their talk with journalists after the decision?
After the decision, you're talking about 75, the news that came out yesterday?
Yeah, why
because
not
they're not
float it
really supposed
later?
to be talking right now, right?
Right, which is why they leaked it through the
If they did,
But did they leak it? Like, what is this? Or is this like...
This is such a journalist conversation.
Right?
It is.
Well,
Get us
trader
outside of baseball.
conversation, right? I mean, is there going to be anybody truly caught off guard by what happens tomorrow is what I want to know. You heard Mark Lazary say he'd rather not guess. He'd rather just wait and see what happens.
Some calmness perhaps maybe reigns today, at least when we think about, Caroline, some of the sort of major markets here after huge volatility yesterday. A little bit lower here, underperformance from the Dow and S&P that closes off about 0.4%. Tech finally sort of a big outperformer, and NASDAQ up about 0.2%. And, well, some calmness as well, but some underperformance in the Russell 2000 off about 0.4%, Carol, as we think about some of those more domestically focused stocks here and how the impact of the Federal Reserve indeed sort of impacts them.
Yeah, and amid all this volatility, some of the outperformance among the transports, the Dow Jones Transportation average up about 2.2%. Thank you, FedEx, for raising your dividend and lowering CapEx. And then C.H. Robinson Reuters basically saying DSV interested in the company's global forwarding business. So we did see some movement to the upside when it comes to some of the transport names.
And when you're talking about names, let's talk about sectors for a second here, because you did see most of the major sectors still red on the day. You were led lowers by utilities more than anything else. Consumer staples still had a very rough day. You had a little bit of green on the screen: auto, transportation, software, services, semis, tech. But, you know, again, mostly red on the day, but there were some buying opportunities.
Yeah, absolutely. We did see some buying going on. And I'm going to go back to the transports and that FedEx name, because it was up pretty much near its highs, closing at its highs of the session, up more than 14%, as we said, topping the S&P 500. The company raising its dividend and also announcing some board changes. They have had an activist investor, D.E. Shaw, kind of asking for some moves, and they're complying, and investors liking what they got from that company. Oracle, Caroline was breaking down those earnings after the closing bell yesterday. This was topping the S&P 500, again, closing just off its highs today, up more than 10%. We did talk about the earnings reporting results suggesting the increasing move into cloud definitely paying off, and they're seeing some momentum. And then check this out, Zoom, top in the NASDAQ 100, up about 3.5%. Exactly. No real news here. There's some things about a fund boosting its holdings in the company and some different things going on, but nonetheless, this name, though, is down a lot. As we know, it's been a lot of pressure, a lot of selling.
All right,
Not
you got the gainers, Carol. I got the decliners. Let's start with the second worst performer in the S&P 500 today on a point basis. That would be Procter & Gamble. Credit Suisse cutting its fiscal year 2023 earnings estimate, giving it a street low of $5.96. This is about inflation. The company saying in a note, quote, signs of slowing category growth as consumers feel increasingly squeezed by inflation and retailers pushing back on manufacturers' price increases will exacerbate an already difficult operating environment. Also keep an eye on shares of Redfin today, falling by 4.9%. This after the company said it would cut 8% of employees immediately. These companies are cutting their workforces, Compass as well, as rising interest rates cool a U.S. housing market that reached a frenzy during the pandemic. Think back to just a year ago, Redfin shares traded as high as $97 a share, and look at that, down to $8 a share.
Amazing.
And then Digital World Acquisition Corp. This, of course, is the SPAC bringing Donald Trump's media venture public. It fell for a second day in a row, more than 28% today, fell more than 13% yesterday, tumbled today after saying yesterday that the U.S. SEC expanded a previously disclosed investigation and issued another subpoena related to that merger.
Meanwhile, I look at what's been a bit of a sea of red today for once, and it's actually the commodity space. So let's go cross-asset for a moment for our audience. With radio, I'm looking, of course, at some of the massive volatility we saw in natural gas prices. In Europe, spiking up more, 20, 30%, if you're looking at UK and Europe, and in the US, falling some 15%. The reason is all based on the same bit of news, the fact that this key export terminal in Texas is likely to be offline for another 3 months after a key fire. Of course, LNG from the US, about 3/4 of it has been going across to Europe to alleviate the supply issues there. No wonder, therefore, prices up across the Atlantic, and why prices pull back here, because we're going to have a bit of an excess supply as the expectation. Steel falling 1.6%. This is interesting, though. WTI crude down 2%, $118. Why? Actually, a great interview that our own David Weston did with one of a key White House economic advisor, and talking about the fact that maybe we could see any tax on excess profits of big oil companies. Now, that is something we've seen the United Kingdom do already to put more money into the hands of the consumer base, and it's something potentially being dealed about here. And we saw oil just down that little bit as we think more about some legislation that could put some pressure on oil. Overall, we also see what has been a story of dollar strength once again. The British pound by weakening 1.25%, Taylor. The reason, well, you've got Brexit concerns, you've got worries about overall risk sentiment, and of course a strong US dollar. That means basically your Canadian dollar lower, loonie weakening, unsurprising if oil's going to be on the downside, and all those commodity-related pairs in the red as the US dollar is at the highest since 2020.
Okay, Romaine's gone, so I want to do his pop quiz. Carol.
Uh-oh.
How many
I thought I always
basis
quiz
points
him.
have yields jumped in 2 weeks? 100.
I was gonna, okay.
100 basis points in 2 weeks
Yeah.
for the 2-year yield. That is incredible. That's effectively priced in 4 rate hikes in the last 10 trading sessions or so. I know usually here we do sort of an intraday chart. Okay, 86 basis points. I cheated a little bit, but you get the point, right? When we're thinking
Just
about sort of
rounding it up, right?
rate of change and the huge moves that we've seen in the bond market, coming off some of the biggest moves, the biggest weeks that we've had since 2008. It continues again today. Intraday moves of 6 to 11 basis points across the curve. These in the last 2 weeks has just been unbelievable when we think about a Federal Reserve, as Bill Ackman would say, that has totally lost its credibility, and the markets need to see 75, maybe 100 to do it and be done.
All right, speaking of credibility, let's go back to that discussion. If Jay Powell says at the last meeting, I'm not doing 75 basis points, and maybe he regrets having said it, we're just speculating here. Like, does he have to stick to it so that, you know, investors really believe every word that he says at those press conferences? How important is that?
I think he also said at that press conference, though, he would monitor the data.
That's what I said.
Has changed.
That's how I pushed back, and I said the data has shifted. I mean, inflation obviously did not peak. It's obviously not transitory.
Right.
And look at the hot print that we got on Friday morning. That changes the game.
You know what's amazing, though? I mean, to Taylor's point, 100 basis points in just a couple of weeks. It makes you wonder, is there more upside there than even traders are expecting right now, given how quickly things have changed?
Well, is the market just doing the Fed's work for it? Look, we've already got the financial conditions coming down. We've already got dramatic moves in the bond market, in the stock market. You've got already companies signaling that they're going to pull back in terms of their labor. We've got an economy that is already slowing. And the key question, though, is at what point are prices going to be starting to pull back to?
That one. I mean, I had heard from a real estate investor last night that said that with the pace of increases in real estate, you would think inflation should be higher right now. So the question is does it keep on floating higher?
Well, and that's a big one, right? Watch that housing market, which we've seen already impacted by higher rates, right? Certainly in terms of mortgages. I mean, how dramatically does that come down? And that is a sector that, right, trickles throughout the economy because you're buying stuff for the house. There's just so much related for it. And that could certainly lead to some significant downside.
All right, senior commodity strategist Mike McGlone said something controversial on our air earlier today. He said that oil prices will start to come down soon, and we can check in with him in a week, and he'll say that he's wrong if they are indeed higher.
He also thought the Fed might overdo it by doing 70.
He did. He thinks 50 tomorrow.
See? We'll know, though, tomorrow, right? And we'll know the market reaction. All right, that's going to do it. Right.
Who's counting? Yeah.
Tick, 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 tock. All right, that's going to do it for our cross-platform coverage. Radio, TV, YouTube, we call it Beyond the Bell, our simulcast on radio and TV. We will see you again, Fed Wednesday, tomorrow, same time, same place.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Masser, Tim Stenovic, a lot going on, and it is an interesting, and I can't wait. Like, I love Fed meetings. I love to watch the market reaction. I think tomorrow's is going to be a big one, whatever the Fed does.
This is huge. I mean, think back to your years of covering the Federal Reserve, Carol.
Yeah.
Is this the most anticipated that you felt before?
I don't know about that.
You go back to 2008?
Well, you go back to the financial crisis,
Yeah.
and we just, kind of were living on everything that the Fed was doing because it was just crazy, and you really felt like...
So some similarities now? Not even close?
I think it's orderly. Like, I really, we talked about this, was it with Gina yesterday? I do think the markets have been orderly. I mean, the bond market moves and the yields are pretty dramatic because you don't necessarily see those big moves. Taylor talking about 100 basis points, over the past week, she said, or so?
Yeah, 86.
That's dramatic. But I don't know, but I think it's significant as we look at an inflationary picture that the Fed can only do so much, right? The Fed cannot fix those supply chains, but it certainly can impact demand. What are you smiling at?
Because there was a story last night on the Bloomberg about the market rout in treasuries evoking memories of trading before the Lehman blow-up, speaking of the financial crisis.
Yeah, I mean, it's kind of wild, some of those moves. All right, back to world and national news, back to Denise Pellegrini. Hey, Denise.
Hey there, Carol. Well, here's something that could lower prices for you. President Biden is considering lifting some tariffs on Chinese goods. No details yet on the timing, though. New York's highest court has rejected former President Trump's last-ditch effort to avoid testifying in the state of New York, AG's civil investigation into his business practices there. And this clears the way for former President Trump's deposition next month. Sky-high oil prices triggering a shift in the U.S. view of Saudi Arabia. President Biden will visit Saudi Arabia next month. Senate Majority Leader Chuck Schumer has demanded in the past the U.S. get tougher on Saudi, but now he says he's okay with Biden making this trip.
This president, unlike the previous president, is not afraid to talk tough with foreign leaders. So I have every confidence that that President Biden will handle this very well.
And Schumer has previously asked for the U.S. to do more about the murder of Washington Post journalist Jamal Khashoggi. Senate Minority Leader Mitch McConnell says he's inclined to support that gun safety deal that the bipartisan group of senators has been working on. And McConnell says the proposal is also receiving support from another main group.
Just people who own guns, and support for the provisions of the framework is off the charts, overwhelming.
And McConnell says he'll continue to support the package if it sticks to the framework. Survivors and officials gathering in Buffalo today, a month after a gunman opened fire inside a supermarket store there. Mayor Byron Brown.
Words will never convey the heartbreak and pain this senseless tragedy has caused.
I'm Denise Pellegrini, Global News. This is Bloomberg.
All right, Denise, thank you so much. Carol Masser, Tim Stenovic here in our Interactive Brokers studio. Hey, we want to get to a story by Jenny Leonard, Ian King, and Debbie Wu. Talk about a trifecta. And this has to do with China's semiconductor industry. It is showing signs of flourishing, even in the face of Biden administration efforts to counter its growth. And that is raising some alarm bells in Washington, I bet.
Yeah, let's talk numbers here. Chinese orders for chip manufacturing equipment from overseas suppliers rose 58% in 2021, making it the biggest market for those products for a second year running. That's according to data provided by the industry body, SEMI.
All right, while those figures appeared in April, the flood of machinery headed to China is now drawing more attention, especially as a legislative push to bolster the U.S. chip industry with investments and incentives falters. The U.S. Commerce Department, meantime, appears unwilling to crack down harder on Beijing, and that is kind of ticking off some critics.
Okay, so one of those critics is U.S. House Representative Michael McCall, a Republican from Texas, who says, quote, if the Biden administration is serious about securing the semiconductor supply chain in the U.S. and allied and our partner countries, it's absurd to let the Chinese Communist Party buy up and stockpile the global supply of tools and equipment to make semiconductors.
Right, and we know the global chip shortage, which disrupted supplies of everything from cars to smartphones, further inflamed tensions between the U.S. and China. President Biden, ordering a review of supply chain vulnerabilities last year, found that while the U.S. maintains a healthy share of chip design and manufacturing equipment, the industry is highly dependent on overseas sales, notably in China. The tech war is on.
Chip shortage, still there.
And, I keep saying, and I've got to get this individual on air, I ran into this woman at Intel at Milken and was just like, chip supplies, help me. Was it just pandemic?
What did she say?
And she said it wasn't just pandemic. I mean, there are chips in everything increasingly. We are demanding it more and more. And so I think to some extent it will become, already a national security issue.
Cars to smartphones to the Internet of
Defense.
Things. Oh, yeah, of course.
Like communications, satellites. Like you think about how important these are to everything we do on a daily basis. Anyway, all right, we're going to talk more in just a moment, right here on Bloomberg Business Week. Carol Master, Tim Stanovic, and you are listening to Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Another volatile day on Wall Street, another losing day for the S&P 500 index. 5 in a row. That is the longest losing streak since January on the S&P, down 14 points today, down another 0.4%. The Dow down 151, down 0.5%. NASDAQ, though, held on to its gains, up 19 points, up 0.2%. The NASDAQ 100 index, full of tech names, also up by 0.2%. The Russell 2000 down 0.4, 10-year yield 3.47%, 2-year yield 3.42%, spot gold down 0.7, 18.07 the ounce, while West Texas Intermediate crude down 2.1%, 118.36 a barrel. Volatility continues to grip financial markets on concern the Fed's aggressive stance to fight stubbornly high inflation will throw the U.S. economy into a recession. Complete Fed coverage tomorrow on Bloomberg Radio, the Fed decision, 2 p.m. Wall Street time. And yes, we've got the news conference. You've listened to it over the years. That begins 2:30 p.m. Wall Street time. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie. Appreciate that update. Well, our next guest, we caught up back in March of this year. And I got to say, for someone who worked at Amazon, he is thinking about solar energy to make it as easy as buying a book.
We're talking about Peter Faricy, the chairman and CEO of SunPower. He joins us once again via Zoom from New York City. Peter, good to chat with you again. How are you?
Terrific, Tim and Carol. So great to be back. Thank you for having me.
Yeah. Well, it's pretty remarkable that energy prices are even higher than when we spoke to you back in March. I'm wondering how you've seen that affect your business in terms of demand.
Well, you're right. It's shocking to see the increases. You know, utility bills are rising 10, 15%, and it's really hitting consumers.
Our energy went up 3x.
Is that right?
Yeah.
Yeah, you hear a lot of these stories across the country, but what I can tell you on the demand side is it's very strong. We grew 40% in the first quarter, and despite raising some of our prices due to supply chain costs, demand in the second quarter, we haven't finished the second quarter yet, but I expect it to grow even faster than it did in Q1. So we've been very pleased so far. I think between high energy prices and worries about blackouts, people are really getting the message. Solar and battery storage, is the way to go.
It's interesting that you say it. My energy company reached out to me recently and wanted to put me in connection with a solar company to see if I wanted to, kind of put some panels up on my roof and stuff. So, and that just happened in the last week. Was it the weekend or something?
What's their interest in doing that? Like, why would they want you to do that? Is it to decrease the demand from the grid?
I think they all are increasingly, right? And help us out here, Peter. I mean, all companies increasingly have to reduce their carbon footprint. So if they can somehow, source out to more greener ways, that's part of their business strategy.
I think many of the forward-thinking utilities, exactly. They want to reduce the amount of carbon footprint. They're getting a lot of political pressure. But also, when the grid is at its most stressed point, they have to light up these peaker plants. And these peaker plants are typically either coal or gas. They're very destructive on the environment because they can't run them very efficiently. So their goal is really to get, the forward-thinking utilities are thinking, how can we get as much residential solar out there? And I'm not sure if you guys have heard about these concepts of virtual power plants, but it's kind of the concept that utilities will pay for consumers to take their solar battery energy and send it back to the grid when the grid is most stressed, which is usually 6 to 7 p.m. and we all get home and flip on our TVs and air conditioning and everything else. So there's a lot of really good ideas out there that I think are win-win. I'm glad, Carol, you live in a place where your utility is thinking that direction. Yeah.
Sunny New Jersey, right?
Yeah, it's urban, and my roof isn't very big, but I got to tell you, if the price is right, I'd kind of love to do it. One thing I do want to ask you, and I love this about peaker plants. Peakers. I was just like Googling. I had no idea that that's what they're referred to. Hey, Peter, I gotta though take a step back, and we do this with all the leaders.
Yeah.
So much market volatility. You know, we're all like on pins and needles about what the Fed's going to do tomorrow, and I do wonder your stock has seen a lot of pressure. I think down more than 30% from the early April high. Your market cap has shrunk. So has most of the equity universe, to be fair. So volatility, tricky outlook, higher rate environment. What kind of pressure is this putting on you guys? How do you think about it? And do you have outlook? Do you feel like we're going to hit a recession?
Well, I'm not qualified to answer the recession question.
Yes, you are.
Yeah,
you run a business. You run a business. You have to make decisions.
Yeah, here's what I would say. Right now, we have the high-class problem of trying to keep up with customer demand. So I am chasing labor to get more and more installation capacity across the U.S., and as you guys know from all the people you talk to, you're never sleeping very well with the supply chain every night. So we're constantly seeking more production of more panels and more components. So my exclusive focus right now is not on the market. It's really on, there's so much demand out there. You know, we're at a point now where we're going to have our third straight quarter of record backlog. Obviously, that's a wonderful signal about how much people love our products and want them. But, you know, listen, consumers want stuff done fast. They don't want to have to wait 3 months, 6 months.
But Peter, you know, though, like if an economic downturn, at some point people make choices, right? And I don't know how they're paying for this. I don't know if it's cash only or they're, you know, getting a loan to pay for this kind of stuff. Or over time, you know, higher rates might make somebody say, as much as I would love to do it, I might not. So help me, like, give me a little visibility on that.
Yeah, let me give you the landscape. So it's such a big ticket item. You know, the average just solar panel system costs $19,000. So, you know, most of America is not writing a check for this. It's either a lease or a loan. 85% of our customers and 85% of the industry, they're either doing a lease or a loan. Even with the rising interest rates, though, believe it or not, the utility prices are going up so fast and so much higher that spread is still, solar's a really great deal. So our estimate right now is there's about 60 to 70 million homes that would save money if they added solar tomorrow, net of their solar costs every month.
Wow.
And that number is expected to grow to be 100 million by the end of this decade. So it's a pretty strong proposition, even with all the other market conditions you mentioned. Believe it or not, I believe that we're gonna have strong demand for the rest of this year, and then, you know, we'll see where we go after that. We get pretty strong signals way up the demand curve because we see how many people are shopping on our website and how many people are setting up appointments, and that's been very, very robust this year.
Well,
even as of last week, very strong demand.
Let's say there is a recession or there is this pullback in consumer demand. We're seeing it in terms of consumer sentiment with the way that consumers are feeling. We know they're concerned about inflation. We know high energy prices are eating into their wallets, and it's not just energy for, you know, powering the home. It's of course filling up the car as well, Peter. At what point do they start to pull back on purchasing solar or financing solar? Like, what is the calculation that you guys have done when it comes to this type of data?
Yeah. So most of our customers are telling us today that they're saving, you know, couple $100 a month when they install solar.
Even after paying for the outlay.
Even after paying for solar. Yeah. So I think as long as they continue to save money, I don't expect that any kind of, recession issue will have an impact, because at the end of the day, the equation for consumers is really easy. Am I going to save money on this if I take a lease or a loan?
Okay, so let me ask the question.
Right now, that's what people are seeing.
Let me ask the question a different way, because our Bloomberg Intelligence Senior Commodity Strategist, Mike McGlone, came on earlier with us and talked about this being peak oil right now. And that's his prediction, that we'll start to see energy prices come down. What happens if and when we start to see energy prices come down and my energy bill goes back to what it was 2 years ago rather than what it was last month? Then does demand dry up for solar?
I don't think so, and here's why. So over the last decade, solar prices have come down roughly 70 or 80%. So it's really a much more affordable product than it used to be. You know, I think the choice that people will make is, do you want to have something that's clean, and do you want to have something with a battery that gives you resilience with all the grid outages we're expecting this summer and with all the extreme weather that we're seeing? You know, now it's kind of a year-round thing. And I think more and more people are choosing to move that direction, and I really don't see it slowing down. First of all, I don't see traditional utility prices getting back to normal anytime soon. From what I can see in the energy world, that looks like some of the price increases have happened, but there's maybe more on the way. So, like I said, I think it's too hard to go very far in the future, but I'd say at least for the rest of 22 and into early 23, it looks like demand's remaining pretty strong.
Hey, one thing we want to ask you, and I'm going to be, props to our Brian Eckhouse, who's like, hey, you're talking to Peter, you got to ask him about this. President Biden, looking to kind of diffuse, I guess it's safe to say, a very complicated trade dispute that has paralyzed the U.S. solar industry. And he's imposing this 2-year freeze on new tariffs for solar imports, invoking the Defense Production Act to support U.S.-made panels. I don't know that it affects you guys specifically, but how does it, or how do you think about this? And do you think your company's share price has maybe suffered because of it?
Well, I'm excited about where they want to get to, especially in 2 years, where they really want to incent, onshore production of solar panels. I think that's fantastic. Carol, we announced at our Analyst Day a couple months ago that we're in late-stage discussions with a company called First Solar. They're very famous because they're based here in the U.S. and they make their panels here in the U.S. So I think there's just a great opportunity as we move forward to get more and more of this industry production onshore. Having said all that, you're right. The decision that he made to sort of postpone any action there had no impact on our business. But what it basically did is it will continue to keep prices low because it will allow companies to source panels from all parts of the world, including China. And it will make sure that there's continues to be great value in buying solar, particularly, again, compared to traditional energy prices.
Peter, how are you reimagining things at SunPower, given your background at Amazon and SunPower being more of a tech company in the past few years? Now you're trying to create this marketplace for solar batteries, EV charging. What's that look like?
Yeah, it's really fun, actually. The area that I think you can see it the most, Tim, is with our new home builders. They're building homes, like we have partnerships in California. Automatically, right off the bat, the home starts with solar panels, battery storage, and EV charger. And I think if we were all to skip ahead a decade, we'll laugh at the fact that there are still homes that don't have that, that package together, because that's kind of where the world's headed. And I think what consumers are going to expect is that it's going to be really easy to use all of those, the solar, the battery storage, the EV charger, because there's going to be a simple app that makes it very easy for you to know when you should charge and how to save money. It's going to give you good insights about your energy usage. And I think we're headed to a territory where people are going to feel really good about the fact that their energy is being served by the sun, which is a very big difference than fossil fuels, and that they're totally in control of their energy usage and their energy costs. So I take a look at the new home builders and take a look at the comments we see from those customers.
Right.
And when they build a new home, they just roll those products into their mortgage. So it's even a simpler transaction for us and for them. But I think that's where the world's headed. You won't see new homes built without solar and battery storage and EV chargers as sort of an essential good like you would for HVAC, for refrigerators and stoves and the like. I think it's going to be part of the basic package for all new homes, and you'll see the rest of the country begin to retrofit themselves.
All right. Well, always appreciate your time and good to check in with you, and we look forward to the next conversation. Peter Farsi, he's Chairman and Chief Executive Officer of SunPower, joining us on the Zoom right here in New York City.
Let's get a check of everything happening after hours. Here's Charlie Pellet.
Hi, thank you very much. We are at the low of the year for the S&P 500 index. Another down day, 5 in a row, longest slide since January. S&P down 14, down 0.4%. All about inflation, all about the Federal Reserve. We did see a late-day rebound in technology companies that pushed stocks away from session lows. NASDAQ up 19, a gain of 0.2%. The NASDAQ 100 index also up by 0.2%. But the S&P, worth repeating, down 0.4%. The Dow dropped 351, down 0.5. At the worst level of the session, the Dow was down 372. 10-year down 29 30 seconds. 10-year yield 3.47%. The 2-year yield, 3.42%. Spot gold, 18.08 the ounce, down 0.6%, while West Texas Intermediate crude dropped 2% today, 118.48 a barrel on WTI. So lots of speculation about the Fed will go 50 or 75, perhaps 100 basis points at tomorrow's meeting. Megan Horniman is Chief Investment Officer at Verdance Capital Advisors. And right here on Bloomberg Business Week, she told us that is not the only option for policymakers.
They could do other things that they didn't make any mention of. They were very clear that the balance sheet runoff, could accelerate that if necessary. So I think you may see some acceleration in that balance sheet runoff to kind of make up for those people that were looking for 75. But I also think that they can, and maybe by learning their lesson, insinuate that the rate hikes in the next couple meetings could quite possibly be higher than what we have.
And, of course, complete Fed coverage right here on Bloomberg Radio with the kind of analysis and insights that you have come to expect over the years. 2 p.m. Wall Street time, of course, when we get the decision. 2:30 when we've got the news conference. Yes, keep it locked into Bloomberg Radio for complete analysis and reaction. FedEx boosting its dividend and announcing board changes. FedEx shares today delivering big gains, up 14.4%. Apple securing the long-term rights to stream Major League Soccer, football, and the rest of the world, taking another step in its growing ambitions as a sports broadcaster. Today, Apple, among the tech names, advancing up 0.7%. Recapping 10-year yield, 3.47%. S&P down 14, down 0.4. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, AB InBev thinks a lot about ESG. It relies on natural resources, as you know, in a big way. No water, no beer, basically, it comes down to. And that easily makes the business case for doing what they do. It's incredibly clear. The company has set out a series of sustainability goals for 2025. They've got a pricing mechanism that incentivizes improvement in 4 key areas. And part of that ESG mission is also smart drinking, which is something we're going to talk about.
John Blood is Chief Legal and Corporate Affairs Officer at AB InBev. He's with us right now in the Bloomberg Interactive Brokers studio. John, I want to get to everything that Carol just mentioned, but given the volatility that we've seen in the markets, given the macroeconomic headwinds that we're seeing here in the U.S., around the world, rising commodity prices, I'm just wondering how somebody in your position as Chief Legal and Corporate Affairs Officer looks out over the landscape and thinks about the health of the U.S. consumer, of the global consumer.
Everybody just relaxing, right?
Everyone just relax, just relax and open a beer.
You know, Tim, look, I fill up my gas tank like everyone else. So, I feel it, and I feel for consumers as well. And one of the great things about the beer category is it's an affordable luxury. You can go out this weekend, you can have a Stella Artois, right? You can go in, you can enjoy yourself. The price point is right there. We have a portfolio approach at all different price points. So it's really a great luxury that you can have in these types of times.
I mean, one of the things that I'm so floored with talking to you and your senior executive space is that you guys have to understand your supply chain so well, right? Because if things don't go well, it just all breaks down. And you also understand the impact of climate change on that supply chain in a big way, which is why your sustainability initiatives are really impressive and you've had them in place for a long time. Having said that, how would you describe your supply chains today?
Yeah, for us, if you think about beer, right? For us, take the United States for an example. 98% of what we sell in the U.S. is brewed here. Mm-hmm. We're talking U.S. farmers. We're talking folks in the U.S. making it, distributing it, brewing it, getting it there. So that's 98%. But that doesn't mean we're not immune to the world, right? And that doesn't mean that we also look out and say, what can we do to plan? What can we do to get ahead of things? What tools do we have in our toolkit? And because we're a global business, we have a business in China, we have a business in South America, we have a business in Europe. Talking to those folks about what's on the ground is important for us as well.
I want to hear about what you're hearing from the farmers on the ground here in the U.S., because it's been a tough run for farmers with fertilizer prices going up, with severe weather in many parts of the country shortening the season. What are you hearing from barley farmers, from hops farmers?
Yeah, so for barley and hops, this is something that we try to plan out as best as we can, and particularly when you take a look at something like organic, right? One of the beers that we have is an organic brew, right, called Organic Pure Gold, mm-hmm. which is a Michelob Ultra product. And to get someone, right, to the farmer to come in and say, hey, we want you to plant organic barley, right? That's going to take some time. Right, we have to work with them. We have to give them those long-term contracts. And we really see ourselves in the industry, and you need to look at yourself as part of the whole chain. So we feel for those farmers. We try to give them those contracts to give them the stability going forward to say, particularly on the organic side, we're going to work with you in the long term so you can transition to that.
John, I feel like this is so into so many of the conversations. We were just talking with Peter Farsi, the CEO of SunPower, and just talking about, certainly when it comes to trade tensions between the U.S. and China, that impacts certainly the solar industry. But I also think about that, what is the responsibility when it comes to our global supply chains? You guys have just taken the initiatives a lot on your own, right, to make sure you ensure the stability and purity of those supply chains. What is, though, the government role, especially when it comes to things like, and I know this isn't your wheelhouse, but whether it's semiconductors or water or what have you, because some of this becomes like national security issues. And I do wonder, is your responsibility, I'm sure you're dealing with folks in Washington from time to time.
Sure.
So I do wonder the conversations that are coming out or that we need to be having when it comes to our national supply chains, especially coming off of the pandemic.
Yeah, well, I love this question because it really hits home that if you think as a business executive, you're going to solve any of this by yourself, and you're going to sit in your room and you're going to get a PowerPoint open, you're going to plan something out, you are mistaken. You need to work with partnerships. You need to work with your stakeholders. And the first thing to understand is, who are your stakeholders? So your stakeholders are national governments. Your stakeholders are farmers. Your stakeholders are these consumers. But your stakeholders are the communities as well, where you're looking for these supplies to come out of. So if, in fact, you're working with folks who farm in another country, what are you doing with them to make sure that they're planning? How can you give them something as simple as maybe financial literacy? We have a program where we work with a lot of our farmers to say, we want to help you become better farmers, but more importantly, we're not going to teach you that. You're going to learn from other farmers in other countries.
Right.
You're going to learn from other farmers down the street, and we'll put that together so you can understand when the weather changes, about what's the best technique. You can share that, because at the end of the day, that community is something that can learn from each other, and we can be a vehicle to that.
It sounds like, too, that you're not going to necessarily wait for governments to do all the things, right?
I don't think you can, right?
Okay.
I think you need to partner, but I don't think you can wait. And by the way, waiting for me, right? Sometimes, right, you wait and you sort of look at something, but when it comes to things like supply chain, activity, right, planning, but more importantly, talking, right? Talking to people, reaching out to those stakeholders is key.
All right. I know you came in to talk about smart drinking, and we're going to get to that. We're going to do a little break, do some news, and then we're going to come back. We have a nice chunk of time because this fits into your ESG, the corporate thinking, really, over at AB InBev. So we're going to come back with John Blood. He's Chief Legal and Corporate Affairs Officer at AB InBev here in our Interactive Brokers studio in just a moment. In the meantime, we do want to just remind you how markets close. This is one day before that Fed meeting, so we're all kind of on pins and needles. The S&P 500 just down about 14 points, certainly off its highs and lows of the day. Same story for the Dow, down 151 points, down 0.5%. And Tim, we did see the Nasdaq just eking out a small gain of about 0.2%.
Let's get a check on the latest world and national news now. For that, we go to Denise Pellegrini in the Bloomberg 1130 newsroom in New York. Hey, Denise.
Hey, Tim, thank you. Well, Senate negotiators working on a bipartisan gun control legislation. They're now talking about a possible vote on this next week, and it looks like the framework is getting growing support, because now Senate Minority Leader Mitch McConnell says he's in favor of the framework, and he's calling it all evidence Washington can all work together.
And further demonstrates to the American people that we can come together, which we have done from time to time on things like infrastructure and postal reform, to make progress for the country.
And McConnell commenting to reporters, President Biden will be heading to Saudi Arabia next month, and a visit with Crown Prince Mohammed bin Salman is in the cards. The White House is confirming the president will make that visit as part of a Middle East trip. The president once promised to make Saudi Arabia a pariah, but Bloomberg's Anne-Marie Hordern reports the situation has changed.
The war in Ukraine, Russia's invasion of Ukraine, that has started to shift the tides in a number of capitals around the world about making sure they shore up their allies. And it changed a lot of diplomatic priorities, and that's obvious for this administration.
And Bloomberg's Anne-Marie Hordern in Washington also saying Biden will be going to Israel and the West Bank as part of this trip. Caterpillar is leaving Illinois. It is relocating to Texas. Some pullbacks in the real estate sector. Real estate broker Compass is cutting about 10% of its workforce. Redfin cutting about 6%. And the FDA has approved a historic treatment for the hair loss autoimmune disease alopecia. And this drug is sold by Eli Lilly and another company. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. John Blood is our guest. He's Chief Legal and Corporate Affairs Officer at AB InBev here in our Interactive Broker Studio. We're going to come back and talk about smart drinking and ESG. But in the meantime, we started talking while Denise was doing news about non-alcoholic beers. I mean, you guys do a lot in the space.
We do, and it's an exciting opportunity. We have 46 non-alcohol beers all around the world. And one of the things that we learned was that when we have a non-alcohol beer with the name of our alcohol beer, so a Bud Zero or a Stella Artois Liberté, this is something that resonates with consumers, and it's something that drives the category. It's an exciting opportunity because, let's be honest, the taste over the last few years has really, really got that beer taste now. In a 0.0 now, it can really be, for someone who's looking for a non-alcohol beer for that occasion, you can pick up that Stella Liberté and enjoy.
You can't go to a restaurant, I don't know, like in Brooklyn, in New York City right now, and not find an NA beer on the menu these days. Same goes for many of the beer bars, John.
Full disclosure, you like.
Oh, I love NA.
Yeah.
I mean, I think that the majority of what I drink alcohol. I drink beers, but the majority of what I drink is NA. John, what's the growth in the category that you're seeing right now?
Yeah, so let me talk a little bit about where it comes from as well. If you go to a country like Spain or a country like Germany, right, you've seen that growth in NA for years, right? There's this great story of the German team at the Olympics, right, and they're taking a non-alcohol beer with them for recovery, right? They're even taking alcohol beer, low alcohol beer with them for recovery, because beer at its heart, right, is a fermented product. It's a natural product. And what's in there is something that, you know, athletes will say, look, this is something post-workout, I want to get my non-alcoholic beer. It can be really, really a great growth for us because that's where the consumers are going. This health and wellness trend, man, people want different occasions. People maybe don't want a soft drink. They want to go have a beer. Man, a non-alcoholic beer is a beer.
All right, we're going to come back, continue with John Blood, Chief Legal and Corporate Affairs Officer at AB InBev. We're going to talk, as I mentioned earlier, they're doing a lot in the ESG space, but we're going to talk about smart drinking and how that factors in as well. You are listening to Bloomberg Business Week right here on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet, just getting word from the Monster Beverage Board that it has authorized a new $500 million share buyback. It was another volatile session on Wall Street, another losing day, 5 in a row for the S&P 500 index. Longest losing streak since January. The S&P now at the low of the year. Down another 0.4% today, falling 14 points. The S&P now at 3735. The Dow down 151, down by 0.5%. And that's a recovery from where it was at the worst point of the day, having down 372 points, down 1.2%. NASDAQ, though, in the green. A gain today of 19 points, up 0.2%. The NASDAQ 100 index also up by 0.2%. Russell 2000 down 0.4, 10-year yield 3.46%, 2-year yield 3.43%. Spot gold down $10, 10 cents the ounce to $18.09, down 0.6%. West Texas Intermediate crude down 1.7%, 118.87 a barrel on WTI. So again, recapping, 10-year yield 3.46%, S&P down 14, down 0.4%. And that's a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. I want to get right back to our guest, because here in our Interactive Brokers studio is John Blood, still with us, Chief Legal and Corporate Affairs Officer at AB InBev. And we were talking about kind of the industry and what you're seeing in terms of supply chains. But one thing we wanted to get to, because you are a company that has really laid out sustainability goals. We talk a lot about ESG, getting a reckoning, and people wanting transparency. As part of ESG, though, you guys think about safe drinking. Talk to us, or smart drinking. Talk to us about that and how it fits in. Because, right, we're living in a world where there are multiple stakeholders, and that includes our consumer.
Yeah, thanks, Carol. When I think about smart drinking, right, when I think about what we do with our product, right, I think about my family, right? My kids ride their bikes on the street, right? I want to make sure that we have the best programs for anti-drunk driving, right? I want to make sure that we have the best programs for people to remind them about smart drinking, really what we call social norms marketing. This is something where you're not just in the old days of like, hey, we're going to raise awareness, right? That's 10, 20 years ago. This is evidence-based programs that give people actionable advice. Now, it's simple actionable advice. It'll be things like hydrate between drinks, have a non-alcohol beer with the beer, eat before and while you drink. Simple things like don't drink if you're pregnant, plan to have a ride home. Those are the social norms advertising that's away from drink responsibly, drink responsibly. We do want people to drink responsibly, but we need more than that. Today, you need to be more action-oriented.
What prompted that change? Because drink responsibly is something that I remember going back, decades at this point when it comes to marketing. What changed this to actionable advice? What was that pivotal point?
Two things, Tim. One is the science, right? When we work with academics, they tell us this actionable advice, this social norm advice can make a difference. And the second is, about 5 years ago, right, we were looking at our programs and we said, we have all these smart drinking programs around the world and we think they work. We've been doing them for years. And then we asked ourselves, does anyone have any data if they work or not? Has anyone tested this, and how do you test it? And that's where the process started. We wanted to test it. We wanted to make it evidence-based. And by the way, we share the evidence with all those who want to look. We have a foundation that does it. We work with academics. Whoever wants to look and look at it, we test the programs and go with the ones that have the biggest and best impact.
What's the biggest piece of advice, for our kids? Like, I grew up in a family where older parents, I don't know, like different era, like there was alcohol in the house, and I had my first drink with my parents, at a relatively young age, for better, for worse. But I am responsible about drinking today. But how do we approach this with kids?
Yeah, and this is a fascinating question, because you take a look at the U.S. and you take a look at the rest of the world, right?
Europe.
There are cultural norms, right? There are laws as well. Of course, we tell kids, do not drink, right? When the law says whatever it is, that's the law, you need to enforce it. However, right, when we deal with alcohol, right, when we deal with what we call these social norms, it's so important, right, that when we deal with it, we remember that alcohol is often part of the special, and beer in particular is part of those meaningful moments in life. When someone says, let's grab a beer, right? They're in part talking about the beer, but they're talking about the social connection. Oftentimes when someone says, let's grab a beer, they want to have a meaningful interaction with you, right? They want to have a real conversation. They want to be together. And sort of balancing that in the right way is what you really need to talk to everyone about, right? You need to talk to them about, this is how you respect the product. This is how you enjoy the product by treating it the right way. And that's what smart drinking is all about, reminding people. It's like nudging them, right? Social norms also is about, some people might think, oh, on Thursday night, my friends go out and they drink 6 or 7 beers. You know what? When you look at the data, it's not the case, right? They're drinking 1 or 2. When you remind people of that, you can then nudge and change the social norm so people behave differently. And that's what social norms is all about.
What about when it comes to drunk driving right now? Because Anheuser-Busch's Decide to Ride campaign has partnered with Uber. And I think back to just my own experience in my 20s. And I lived in the mountains, and there was no Uber. There was no Lyft.
Right.
There was a huge problem where I lived when it came to drunk driving. There was this terrible joke that, you know, to be a local in Vail, you needed to have ACL surgery and a DUI because then you really lived there. And I wonder how much Uber and Lyft and ride-hailing has changed this, because it is so easy to find a ride.
You know, it is all about sort of embracing the moment, right? When technology gives you something that allows you to nudge society towards a healthier pattern, towards a social norm that's positive, you need to embrace it. And that's why we're so happy with Uber and Mothers Against Drunk Driving, right, is part of that program of Decide to Ride, right? Saying to folks, you know what, there is a solution. And it's very important to remember, Tim, as well, when we talk about Decide to Ride, it's not just, oh, hey, you get a free ride home or you get a discount ride home. It's about the mindset of, I'm gonna plan. I'm gonna plan to ride. And I love your generational approach here, because if you talk to the 21, 22, 23-year-olds, right, it's almost instinctual now. Like, no, I'm gonna use Uber. Why would I take the risk? Why would I do this? And it's a different mindset, because I'm a little older than you, Tim, but I remember that attitude even worse. And what social norm's about is nudging, is changing the way people behave and act. And that mindset is super powerful. And that's why you see drunk driving numbers over the last 10, 20, 30 years coming down.
Right.
You know, it's interesting. What do you, okay, this is very random, but like cars making, you know, you can't start the car and that you'd have to blow into like a car. Do you think that's a good thing? You know, as part of this process, technology, think about how transformative it can be, but think about how that could take it to another level. You can't start a car if you blow a certain alcohol level. Like, how do you guys feel about something like that?
Yeah, so when you see about the powers of technology, right? Now, we've seen some research on everything from when you touch a steering wheel, it'll be able to measure your blood alcohol level through your skin, to sensors in the car. Look, one thing that we at AB InBev love, right, is embracing technology to solve problems. And man, if we get the right technology to solve it, and we measure everything about there, we talk about all the different elements of privacy rights and all those types of things, but that's an exciting time when technology can really make a jump leap. Wow, that's very exciting.
I am like blown away. It's really interesting. I'm optimistic in a world that's very dark, that you say like things are getting better when it comes to like drunk driving, right? We're seeing statistics, some of the work that you guys are doing, it's making a difference. Just got about 30 seconds.
Yeah, no, exactly. And also around the world as well, right? So, you know, you have the US issues, right? But, you know, being able to go to a country and run the first anti-drunk driving campaign, to have a brand embrace that, is really, for me, the exciting part of being about a global company.
And it's amazing that it's the first in some countries, right? Considering it's certainly been a chronic problem for a while. So I think this is an important issue. We have so many important issues that are really dominating our world right now. I mean, we talk a lot about opioids, we talk about guns, but let's not forget that the amount of people who lose their lives, right, still because of something like drunk drivers. Jean-Claude, thank you for stopping by. We really appreciate it. Next time we're going to do an NA segment.
Sounds good.
He's Chief Legal and Corporate Affairs Officer at AB InBev. For Tim Stanovic, I'm Carol Massar. Have a good and safe evening. This is Bloomberg.